welcome everyone to SmartCon, and today we have with us both Xavier from Solve as well as Misha from Symbiotic. Maybe let's kick things off by for SmartCon and this being the first panel and fireside chat between us. Maybe Xavier and Misha, would you like to introduce yourself?
Yeah, cool. Hi, I'm Xavier. I'm a product at Solve. So maybe I just have a few moments to talk about Solve as well. So Solve is the operational layer for institutionalized Bitcoin finance. We have kind of three main products. The first product is SolvBTC, which is the one-to-one Bitcoin wrapped asset. That's the kind of the hub of what we do, of everything we do at Solve. And then we have two other products, other core product, which is XSolvBTC, another kind of yield-bearing BTC product that generates yield via providing proof-of-stake guarantees on Bitcoin networks. And then lastly, we have BTC Plus, which is a very new product, and this is kind of the product that we have launched this year, the key product, and is what we'll be focusing on this year. And what it does is basically a diversified yield product for all institutional partners and also retail partners, and generates use in various different ways. So at Solve, we've currently kind of have a proof of concept where on BNB chain, we have kind of $600 million in volume of lending and borrowing. So very positive kind of proof of concept on BNB chain, where we are the largest BTC wrap player on chain there. And then we're kind of trying to translate this over to many other chains with the help of course, Chainlink, and also various different products, of course, with the help of Symbiotic. So yeah, pretty excited to be here and chat about the restaking and real-time monitoring here.
Thanks, Xavier, for having us. And definitely, we've been working alongside with Solve for the past really 1.5 years, 2 years, right? And it has been great working alongside with you guys. And Misha, you're no stranger as well. Would you like to introduce yourself and tell us a bit more what Symbiotic does?
Yeah, I'm Misha. I'm co-founder of Symbiotic. We do universal staking. So basically, we've created a Rails for assets to be used as a collateral, as a source of security, and we enable networks to launch earlier and financial products to launch earlier, launch safer, and moreover, create an alignment structure that is really works well for them and their stakeholders. So what that means is that we provide staking infrastructure that enables assets that might not be utilized that well to deliver value while retaining yield that is sticky and really predictable. So we started with the decentralized networks, right? Like bridging, fast finality for rollups, oracles, you name it, ZK coprocessors even. And now we are doing finance products as well, because it's kind of the same, right? Like you delegate your assets to some trusted party, and then this party provides you with this yield source, be it from operation of decentralized networks and moving into insurance and stablecoins and everything in between.
Absolutely. I think Symbiotic was one of the first few staking infrastructures that I was really excited about when you guys launched. And I think over the years that you guys have been up, you guys have secured like hundreds of millions of dollars of assets, right? Now the big question will be, why are three of us together on stage? Like, what exactly are we trying to launch? Maybe Xavier, you can share a little bit more.
Yeah, awesome. Yeah, I think we're excited to kind of announce that we are running the restaking vaults with Symbiotic, in partnership with CCIP. So this helps us guarantee and also provide security, crypto economic security assurances on top of the CCIP network via the Solve token, and also that helps secure our SolvBTC bridge transactions. So I think the main reason why we want to do this is, number one, actually CCIP already secures most of our cross-chain transfers across our, of course, I think 19 different chains that we have. And then I think this symbiotic restaking adds kind of like a alert layer as well, not just it's crypto economic alert layer, and it detects anomalies which could pop up and also kind of like patterns that are suspicious that could pop up anytime during the bridge transactions that, that could seriously affect our operations. And I think lastly, the most, and also like to just tie into everything, we use our Solv token as the as kind of like an assurance for this entire pool. Maybe Amisha can add more to how the entire thing works in depth. But like this also provides us a use case for our governance tokens to have our retail users like deposit the Solv token into Symbiotic and then have also earn some rewards for guaranteeing this crypto economic layer. Yeah.
Yeah, maybe Misha, you're the expert. Given that it's really relying on your protocol, Symbiotic's core infrastructure here, how would you explain to a layman how exactly does this staking infrastructure work? What exactly does it do? And in this particular case where we are launching the observability of cross-chain transactions via CCIP for SolvBTC, how does that come into play?
Yeah. Well, like first of all, we're super proud to work with you guys on this. Yeah, if you simplify how it was done before, is that you had like a bridging mechanism, like some messaging layer that your app used for like cross-chain transactions, and it was like provided by like some third-party service, and like you paid them some fee monthly or yearly or something, and like your actual stakeholders that like support your protocol and participate in governance and other things, they were not like actually like related to that in any way. But what we are trying to do and doing right now is that we are creating an alignment structure. So the stronger the native tokens of the involved protocols are, the stronger the economic security they have for the actual operations. And while doing that, they create an incentive alignment. So your infrastructure is staked through your tokens and rewarded for that. So you kind of like, otherwise you didn't have that like value capture internally because you offloaded it to like some tokens, bridge token or something like that, right? And here you can create an infrastructure like layered pie. So like bridging, maybe oracles on top of that, maybe then like the app chain of your own sometime in the future, maybe something of this sort. And everything is going to be like, there's going to be one underarching team of that. It's going to be supported by the tokens that you align with, right? So it's not going to be like, so you're not going to be like feeding some infrastructure provider that's not actually aligned with you in any way. And we are doing this with the pre-deposit vaults. And Symbiotic will provide the staking and delegation infrastructure for this, as well as like backend layer through Symbiotic Relay. That's going to be basically delivering messages everywhere. And like this experiment is like not experiment, the pilot that we have is really interesting in a way that it creates like a base layer for trust for the infrastructure, for Solv ecosystem and Chainlink ecosystem that can be easily scaled upwards. So basically every new infrastructure initiative can be built on top of this foundation quite easily. You don't have to like migrate funds. You don't have to like, it's just like your users like, am I interested in just bridging? Like, or am I interested in this, and this, right? So it's easy opt-in. That's where restaking comes in, because you don't have to like pick and choose. My token is like going to be allocated to this or this. I can like select the wider range of things to do with that.
You brought up a really good point, Misha. I think one of the key things that you mentioned is ability for the community members, right, to participate in like providing additional assurances, right?
Yeah.
And in this case is for cross-chain. So specifically for this use case, I think we have launched 2 vaults, right? So there will be a Solv vault as well as a Link vault, and they would actually, the vault holders will provide economic security based on the assets in the vault, right? For the various different network operators that's via on Symbiotic, to have additional alerting system on top of the trust assumptions that CCIP already has. They have been securing like trillions of dollars of value via the Oracle infrastructure, the decentralized Oracle infrastructure as well. So, but I think that you brought a good point. It's mainly for all the different parties to have participate in a collaborative manner on the security of the protocol. maybe on Xavier's side, for you, like, I mean, we spoke about CCIP. You mentioned that you have been using CCIP really since 2024, right? What motivated you, right? In terms of like using CCIP and now with this particular infrastructure using Symbiotic as well.
Yeah, I think the main thing for our partnership with CCIP, of course, is to have secure interoperability. Back then, when we were only on one chain, or maybe one chain on BNB, or Binance Smart Chain, we were looking to explore definitely the DeFi ecosystem and expand into different L1s and layer 2s, of course, on top of Ethereum. So that's where I guess the first time we kind of connected and started our partnership, and it's been a very, very fruitful partnership. I think since then we have been on countless chains, and then just the partnership has been even more collaborative nowadays, even just working on different ecosystems such as like Solana. Chainlink's helped us not just on the CCIP side, but also deploying the tokens actually on Solana. So I think that's been a very fruitful relationship. And then following that, I think we have also worked with you guys on various items like the proof of reserves that help us guarantee all the proof of assets on Solv protocol itself. So to provide investor confidence, not just on the DeFi side, on the retail side, but also on the institutional side. And then right now we have also worked on different oracles with you guys on, like, for example, the exchange rate oracles that powers our lending initiatives here on basically all chains right now. So yeah, it's been a very fruitful partnership. And then just the main reason, as I explained earlier on with Symbiotic, is definitely like Luke mentioned, providing, like, number one, increasing our security on bridges, and then number two, just having everyone have a stake on, like, the crypto economic security of Solv protocol, especially our token holders, and also just all our partners as well. Yeah.
Interesting. I think that brings to, I guess, the next part of this fireside chat, which is more so for on Misha's side, right? You were mentioning cross-chain transactions being one use case, right? But where do you see this takes us? I mean, given how modular your architecture is, what are the different type of use cases you see that this has product market fit and to be useful down the line?
Yeah, as I mentioned, we have data availability working on us right now. So basically, data availability, ZK coprocessor is first. We just launched the first fast finality rollup, and this is infrastructure part. But like the interesting part is that kind of the same assumptions and the same architecture works really well for financial apps. So that was not like 100% expected, but we kind of like designed the system in a way to handle that. And now we launched CAP, our first stablecoin to be launched and secured by Symbiotic, and we have a few insurance protocols coming online and private credit as well. So like when you have interaction between like on-chain, off-chain RWA style assets, it's really hard to create a system that is like inherently stable. So the more capital you have and the more like utilization of a capital and lock-unlock systems you have, like the more stable the configuration can be.
Yeah.
And yeah, like that surprisingly to us, like a lot of people came and like we don't have a decentralized network to handle, but like we have assets that needs to be secured. And yeah, like I think that both parts of this journey like gonna be developing side by side, but it was like really surprising how much of the like TradFi and finance in general needs that like crypto rails for them to keep off-chain, on-chain communication secure.
Yeah, absolutely. And I think you brought up some names that we are also working alongside with. So we'll be looking forward to more collaboration between Chainlink and Symbiotic as well. But maybe Xavier, just to close things out, like what's next for Solv? You guys have launched BTC Plus, but if you can share what should we look forward to?
Yeah, just to quickly kind of wrap up. Right now, Solv is pushing BTC Plus, our brand new product that provides kind of like a diversified source of use And then previously, I think the main problem was that we have different vaults, and now we have just combined them and allocated into a single vault to generate yields at a very decent APY for Bitcoin. So we are offering this, of course, in partnership with Chainlink on the operational side for institutions, retail, everyone, and like currently it's a cap vault with 5% APR. So we are just very excited about that product going forward.
Awesome. So we're runtime, but it was a great fireside chat between us. Obviously, we are very excited to have this launch between Symbiotic and Solve as well. So yeah, we'll be looking forward to more things ongoing.
I want to talk about a project that we did with Chainlink to look at how we could tokenize Telecom's infrastructure. I remember a few years ago, 2018, I posted that I believe that tokenization was blockchain's killer application. So we want to talk about a new development, which is connected digital assets. So this is where we're using our connectivity infrastructure. We're linking that to Chainlink, and we're actually providing usage-based return on digital assets that are tokenized. So I'll talk you through it. Before, I just wanted to maybe just go through a few sort of macro points, right? So the population's increasing, mobile phone use is increasing, IoT devices as we move to AI. The business data for AI is going to come from IoT devices, sensors, cabinets, connected drones, connected vehicles, connected shipping containers. These will provide the data that will move into business large language models. And we're expecting an explosion of IoT devices by 2030. Other things, internet users are going up, AI users are going up. We're expecting AI to be the biggest thing in the next 10 years as more and more people start adopting it for search, but also in business. And there's one thing that we haven't looked at, which is that over the last 20, 30 years, we've managed to build a network of towers, which basically enable mobile communication throughout the globe. There's 5.3 million of them, and we're expecting them to increase. And we're saying, could there be a link between Telecom's tower infrastructure and AI going forwards? What is the size of the opportunity? Well, AI is huge. We're expecting 10 to 15 trillion as the opportunity side for AI going forwards. But there's one issue, and you'll hear this more and more. There's 400 billion in 2025 that's being spent by hyperscalers, and the revenues are only going to be around 200 to 300 billion. So there's a massive investment. That's all we hear about, investment in AI data centers. But the problem is, and Sam Altman and Sadella from Microsoft said it this week, you can't invest because you can't get the electricity. A mega data center requires fresh water supply. It requires masses of power. In fact, one mega data center uses in an hour the power that a city uses in a week. That's how much power is needed. So although you're hearing these announcements about data centers and investment in data centers, the truth is that even with all the money in the world, the grid and the water supply just won't allow it. But what are we doing? We're building this new digital infrastructure for a new digital world. Connectivity is part of it, and that infrastructure exists. Data and compute infrastructure is what we're talking about with this investment. And on top of that, we're overlaying finance and Web3. And what I'm posing here, and what we try to look at with Chainlink is, can telco towers become part of the data and compute infrastructure going forwards? So what is the size of the opportunity for data centers? So McKinsey have got it wrong a lot of times. Sorry if there's any McKinsey people in the audience. But the forecast from McKinsey is that by 2030, between now and 2030, there'll be 7 trillion, 7% of global GDP invested in AI data centers. Morgan Stanley, a bit more conservative at 3 trillion. But what are the problems with this? So part of the problems, you have huge power and freshwater demands. Huge power and freshwater demands are required. So as I said before, in the UK where I'm from, they stopped on the M4 corridor, which is a corridor between London and where there's a lot of the IT connectivity. They stopped development of residential property, right? Because all of the power and water is needed for AI data centers. Not only does it stop development? But you're hearing of increased electricity bills, of other issues with it, right? Now, I'm not saying that mega data centers aren't part of the answer, they are. But what I'm proposing is that maybe the architecture needs some resilience and something to complement it. And the other thing is that in these mega data centers, the chips have a three-year lifespan. So you're putting them in, you're designing them, but with limited use. So part of what we investigated in this, in this solution was, could the 4.9 million telecoms towers across the globe be transformed to become mini data centers? And if they are going to be mini data centers, can they be distributed and work in a collective way? I.e., can you provide them intelligence, right? So you have swarm, a swarm approach rather than to complement the big mega data center approach. So, can towers be transformed into data centers? If they can, is it feasible on a cost point of view, from a power point of view? One thing is that towers already have power, right? So they already have the power. And is it feasible in terms of return on capital employed? And then more relevant to what we did with Chainlink is we looked at, could there be a different financing approach, right? So for one tower in the UK, I won't say which one it is, and it's not the biggest tower company, the financing opportunity to put the hardware in to the towers or alongside the towers was a 1 billion opportunity for one tower. So you can just guess what the financing opportunity is across the globe. So what we were looking at is, okay, we know that some of these towers will draw down on credit, but a lot of the tower companies don't make money. So what you're looking at here is, okay, could tokenization, the thing we've been preaching about, real-world asset tokenization, be part of the solution? Could you tokenize towers, right? And could you tokenize just the hardware that's going to be providing the data center capability? Could you then somehow link that hardware or the tokens in that hardware to a usage feed? And what does this do? It means that every time that the asset is used, the repayment, i.e. the return to investors and what you pay, is linked to usage of the asset. And if you can do that, could you offer this usage feed, this trusted usage feed, as an input to finance products, right? So what does this do? AI is new. Towers don't make money. Their P&Ls don't look good. And there's a number of other industries, not just towers that look like this. But what it does, it diversifies the risk, right? So it means that where the towers aren't being used at the beginning, where AI is getting its feet, the repayments are low. Investors accept that risk. As AI data center usage in towers goes up, the investors will get more reward, but then the tower operators have more money to pay. So we call this asset-based finance or usage-based finance. And offered as an API into finance products, it offers a new benchmark. Rather than P&L and just interest rates, you have a usage benchmark which can be added to finance products. So what is the solution? So what we designed was, so if you look at the preconditions here, the new digital infrastructures, when you're talking about real-world assets, for the usage-based component to work, the assets must be connected. And this is the beauty of what we did with Chainlink. We connect the assets using our Peerpoint technology. Chainlink can then put the outputs and the data from those asset usage on-chain. And then that provides the trust to feed into finance products. So you can see here that layer ones are involved, distributed databases are involved so that the information is trusted. Now we have secure point technologies which secures data at the edge and encrypts it. We then hand over to Chainlink CRE, which then puts that on chain, does a price comparison, also puts the data on chain, and then it feeds into finance products. Another part of the technology that we're doing, and we've been working on this for years, is how you can link connectivity and use the hardware in any connected asset to basically encrypt it, support financial transactions, wallets and financial transactions, and how you can actually use the Java middleware in the SIM card and those keys to sign on different chains, right? So you can see that with this technology, we've integrated with Chainlink, but we can also link to AI models. So where, for example, you have an algorithm which is driving the efficient use of resources in towers or any other asset, this algorithm, we can link to AI models so that the data can be secured and monetized to do that. So as I said before, trusted usage fees. So what we've done here, I think, is pretty significant. There are going to be 20 to 30 billion connected assets in the world. All right, when we talk about real-world tokenization, we talk about properties, right? A home, a hotel, land. By connecting the asset, right, where you have humanoid robots in the future, you have lifts, you have connected vehicles. What we're doing here goes beyond towers. I believe that the tower use case is a $1 trillion use case, but by essentially providing this usage-based finance. But you're talking about every connected asset now, and a new way of finance which is linked to immutable usage, right? Using blockchain to provide that immutability, to provide the trust, the tamper-proof capabilities, and the security. This could be a big change in real-world asset tokenization going forwards. We've illustrated this for towers, as I've said, but this, as I repeat, this could work for any other asset, and you've got the ingredients there, which is the peer point technology, which brings all of the connectivity across the world. You've got over 8 billion smartphones, 30 billion devices, and there's going to be more, right? You're connecting that with blockchain, with an immutable usage feed into finance. Thank you.
Hey, thanks, guys. I'm probably going to take a little bit less than 15 minutes to speak about what we're doing in El Salvador. I know New York is very expensive real estate, and I'm used to a bigger stage, but we work with what we got. El Salvador, many of you, I'm not sure who's heard of El Salvador. If you haven't heard of El Salvador right now, you're probably living under a rock. We are rated the #1 regulation in the world. We have the largest companies in the world. Tether, largest stablecoin in the world, is regulated and supervised in El Salvador. So is Binance, so is OKX, so is BitGet, so is 70 other companies that are global leaders in digital asset tokenization. So today I'm going to share the story of how we achieved our success and the future of digital assets, which it's something that Chainlink shares, which is regulation. I'd like to start by saying that the only reason we've achieved #1 and the reason why we're still the only digital assets regulator is because of the adoption of Bitcoin. In 2021, President Bukele, fellow Bitcoiner, adopted Bitcoin as our national currency. Many of you might know this. And what the biggest benefit of adopting Bitcoin as national currency is to understand that Bitcoin is not a financial instrument. To better understand this, think of the electric car. If you think of the electric car, to us as a consumer, it's a car. But if you bring that electric car to your mechanic is going to have a heart attack. The electric car is a computer programmed to behave like a car. The same thing as digital assets are financial instruments, are computer code to behave like financial instruments, but they are not themselves really traditional financial instruments. Biggest challenge we have today is that we have the traditional car mechanic, which in the financial industry is a central bank, the superintendents of the financial system, trying to work on the electric car. El Salvador, because we adopted Bitcoin, we've rapidly realized the big difference between a digital assets and traditional finance. 2021, the adoption. 2022, the creation of the law. We created the first comprehensive law for digital assets emission. 2023, we created the Commission of Digital Assets, which leads from a technology perspective. It's a technology-first approach on digital assets regulation. Everyone in my team, as soon as you start working from the commission, you either have to be, before you even come to an interview, you have to be knowledgeable in accepting Bitcoin transactions and understanding how Bitcoin works in general. But everyone that actually gets hired by the commission, within the first 6 months, they have to be enrolled in a postgrad in crypto. We have the most educated, the best team, and not just by opinion. Everyone out of the 40 employees, 37 of them have at least a postgrad in crypto. And that's part of what has achieved the success that we have in El Salvador. I recruited the top youngest persons from the traditional financial industry from the regulation side and taught them what digital assets technology can do. And we're deeply involved in working and collaborating with industry. So we've created a smart framework focused on global compliance. Most of you probably don't know what FATF is, the Financial Action Task Force. This is a global regulation that sets up standards for anti-money laundering, and countries are measured against one another on your money anti-laundering standards based on the directives that they put out. So what we created was a way that every single company that comes to El Salvador has the standards to work globally. So all of our companies in El Salvador, there's something that you've heard many times, it's called the travel rule. Comply with the travel rule, comply with all KYC, know your token rules, everything. So we've integrated everything from a technology side, and that's what's helped us achieve what we have done today. Now, where is it that the industry is going? And I guess in our opinion, in El Salvador, what I saw is that the next big thing is the convergence between traditional finance and digital assets. That's been the focus of El Salvador, real world asset tokenization. That's why for us, having the largest tokenization company in the world, which is Tether, they tokenize dollars. It's an important pillar of our building blocks in the country. But we don't just do stablecoins. We got really cool real estate projects, securities, and commodities that have been tokenized. We're selling soy futures from Brazil that are bought internationally and settled in real time and transacted in Brazil. There is a lot of really cool projects that in almost 3 years, we've been able to pioneer how tokenization can improve the flow of money internationally and do better settlements than any other financial activity available to the everyday investor. Now, why am I at the Chainlink conference? I've been in this industry since 2013. Still continue to be a Bitcoiner, although I'm crying today. We're at $103,000. But technologies that do see where the economy is going is technologies that I like to follow. And Chainlink is one of those. Sergey, the co-founder of Chainlink, often says we need regulation. We need better regulation in order to ensure that capital markets move into digital assets. And in El Salvador, we created the better regulations. And now I'm seeing segregation of capital. So in El Salvador, to ensure that we have a transparent market, to ensure that we have an open economy for digital assets, we allow companies to use different standards. So we have companies that are building in Bitcoin, using the Liquid network. We have companies that are building in Polygon. We have companies in Ethereum. We have companies, we're technology agnostic. As long as you follow our standards for anti-money laundering, for traceability of tokens, et cetera, et cetera. But what this has created is segregated liquidity pools. We have, for example, Bitfinex Securities, which is owned by the same people that own Tether, that have $180+ billion of liquidity that only have access to the tokens they launch on their platforms. We have Valerium Markets, which they used to own the stock exchange in Gibraltar, which is a big company that also has a decent liquidity pool, but their products can only be bought by the Valerium Market approved members. And just like that, we have over 20 different exchanges. Even the stock exchange in El Salvador is now a digital asset service provider. So they're doing tokenization and selling products. Now, this is where I see Chainlink being sort of like the missing link that we have, because through the work that Chainlink does, maybe there is an opportunity to be able to join all these tokens together and for them to be able to share that amazing liquidity that they have independently and increase what we're doing. The speaker this morning opening up She talked about this, how in financial markets, when she started, the segregation of liquidity was a big issue. And now that we created this financial market in El Salvador, we're seeing the issue of the segregation of liquidity. In closing, if you haven't heard of El Salvador, you will soon. Worldwide, we're the #1 regulator. We are not the regulators of the world, but we are the #1 regulator in the world. What does that mean? Is that every day we're getting between 5 to 10 applications for companies to come and be regulated out of El Salvador. However, my job is to protect consumer protection for the Salvadorian population, not for Estonia, Argentina, Bolivia, or any of those countries. So this forces us to have a really huge rejection rate. 86% of all the applications that come into El Salvador get rejected for various reasons. Many of them is the standard of the technology is too junior. People don't want to apply AML, robust AML rules. And that's still, that's not gonna fly anymore. And the other big issue is that it's a great company, great product, but what are you coming to do in El Salvador? So we want companies that are actually coming to invest and move to El Salvador to develop things within El Salvador. I'm talking to a bunch of young guys later on today because they have a great product that can be developed in El Salvador and it has a huge market for it. So El Salvador is open for business, but it's open for business for people that are coming to do business in the country or provide a product for our population. In closing, come shape the digital future with us in El Salvador. El Salvador literally is the only country that has a technology regulator that understands the technology, that understands the risk, that doesn't have a cookie cutter template for companies. We look at every single company that applies. We give it a fair evaluation. We create a supervision risk analysis because we still have to supervise who wants to approve you. But digital assets has opened an opportunity for even smaller countries like El Salvador to lead without having to wait for the United States to set the direction. I was mentioning this morning an example that, and this is going to be very realistic of what we're going to see with digital assets. I grew up in Canada, and I remember that when cell phones first started to become available in Canada, I called my father in El Salvador, and I was all excited I had a cell phone. He says, even the maid has a cell phone here in El Salvador. I was like, what? Spend my freaking savings in buying this cell phone, and even the maid has one. And the reason for that is because in Canada and in the States, we have the traditional infrastructure, the landline, the old dial-up technology that cannot be jumped over. Therefore, the integration of cell phone took so long because you had big companies with a lot of big money that slowed down the process of the adoption of the cell phone technology. We are seeing that choke point 2.0 as a result of that, the traditional financial industry not wanting digital assets industry to succeed. It's not going to stop. I don't think that, I think, and every time I come to this conference, I hear the TradFi industry saying keywords like DeFi and all this stuff, but I think that they don't understand that DeFi actually means they don't exist anymore, that it's completely decentralized. The whole purpose of Bitcoin was to be able to exchange value from one person to another without having to have an intermediary. And TradFi is the intermediary. So I think that although it looks like light at the end of the tunnel, I think that we'll see development and growth in other areas outside the United States that do apply international rules on how to do transparent and safe financial transactions. And within that vision, that's why we have set up El Salvador to be the hub of real-world asset tokenization globally. But you do have to be in El Salvador to do business with us. With that, thank you very much, and come visit El Salvador.
Hello. Thanks, everyone, for joining us today. I'm joined by some very esteemed panelists alongside me. Today, we're going to be talking about powering the perp economy. So speaking to a bunch of new age perp dexes who are making a lot of very interesting, exciting design decisions around the perp space on chain, and how Chainlink fits into that, how Chainlink is driving innovation, and how these perp dexes also leveraging Chainlink's Oracle technology to achieve new heights in the perp space. So maybe just to start off with, we'll just start with some introductions. Should we start with Simran on the end and then just go down the line?
Sure. Simran Singh, CEO of Monaco Research, previously TradFi background in commodities trading at Goldman, and then most recently a few chapters at GSR where I was head of DeFi trading.
My name's Alyssa. I'm product lead at Decibel. It's incubated perp stacks at Aptos Labs. I guess I'm also TradFi to crypto pipeline. Used to work at BlackRock. Been in the fintech startup space for a while.
Yeah, Cooper Emmons. I'm the institutional lead at the Injective Foundation. And previous some TradFi background across venture and brokerage before that.
I'm Halcyon from Chainlink Labs. I lead our derivatives initiatives at Chainlink. So maybe just to get started, we've seen a lot of interesting innovation over the last probably like 12 to 18 months. I think I myself have started off with on-chain order books back in the day, probably like Ether Delta, like DYDX leading there. Then we saw sort of this evolution to some of the more like pool-based perp dexes. And then now again, we're seeing this sort of reversion to order book-based clubs on chain, but a lot of them sort of making some interesting design decisions to sort of differentiate themselves. And I don't know if it's that specifically that is drawing a lot of interest in perps on chain, but curious to hear sort of everyone's thoughts about what is the latest thing that's driving the growth of on-chain perps trading at the moment. Simran, do you want to start us again?
Yeah, sure. So I would say it's an amalgamation of a few things, right? I think Hyperliquid built a very strong business model, strong business use case, and they've shown that there's strong product market fit for perpetual exchanges to exist. That combined with, I would say, the advent and significance of RWAs, institutional adoption, all of these things commingling together in just the right way at this time in the development of the crypto lifecycle is kind of what's powering this new age of perp exchanges, right? Perps are not a new concept. I mean, Robert Shiller showed them in 1992 to discuss illiquid assets and how to mark these in perpetual futures. Nothing really happened until MEXC and a few other venues started popularizing perps, but they were never fully embraced on-chain. And over the past few years, the evolution of, I would say, from a technological latency perspective, from an RWA perspective, all of these things have kind of come together to power what the next layer of liquidity is going to look like.
Yeah, I think it's all of that for sure. I think it's also fundamentally just money and attention. Like, I think there is a really intense competitive space right now. People are trying to innovate, find their edge to compete with Hyperliquid and steal market share. And I think that combined with the idea that you can do things on chain that you couldn't do a few years ago, like the idea of completely on-chain trading was not feasible from, trading on Ethereum-based chains where your gas costs were not realistic when it came to doing matching and settlement. So now there's more space to innovate in. It's not just, like the competition itself, but there's more options for people to expand into new areas and build new technology. So that's, I think, a main thing.
Yeah, no, agreed with all those points. I also think perps offer the best UX for people to express exposure to different types of products. And now you're seeing that new kind of assets like US equities or, pre-IPO markets are coming through those same rails. And I think that's the very large opportunity at scale at the moment.
Yeah, very, very interesting. I think everyone who's sort of been watching the space carefully is seeing like expanding into like new markets is an obvious sort of way to differentiate, but sort of everyone I think has got their eye on that as well, trying to cover the most exciting markets for traders that traders want to sort of express some view of the market on chain. But we're also seeing some other interesting design choices. I think like one of the ones in particular has been this like market making vault, right? Where again, it was interesting. I was like speaking before about the reversion. We've seen like this sort of cycle between in a bear market when liquidity's been scarce on chain. We've seen like this like bootstrapping of liquidity through like this like AMM based model, right? Popularized by like Gains, GMX, synthetic, so on and so forth. And then we sort of saw like, okay, when there is liquidity, for trading, like the order book based model is sort of the most favorable way to sort of enable like efficient trading for traders. But then again, we're seeing for like these more liquid or long tail markets, like these market making vaults to bootstrap liquidity specifically also for like those markets, so that whatever market makers are helping bootstrap liquidity on those exchanges have that at their disposal. So they have some like inventory or something to bootstrap those markets. We're seeing that. We're starting to see exchanges expand into multi-collateral. Like up until now, almost all these Perps markets have been like USDC margins, right? So it's sort of an obvious way to expand it. And then obviously like different markets and different things like that. Curious to hear each of your takes on maybe like what you're focusing on specifically to differentiate from others, and also, where you think, that'll take the exchange like in the next 6-12 months, like what'll the evolution be? Should we start with you?
Yeah, we've been spending a lot of time trying to onboard institutional market makers on chain for the first time, because we believe the order book model is the most capital efficient model to get that exposure from a liquidity perspective. AMMs are great for price discovery. However, they're not great for, offering great access or exposure or liquidity for that matter. So that's where we spent our time. We've onboarded 15 plus institutional market makers. And I think that that's really what, has been driving the adoption for us, or the liquidity for us and usage. But I think that a lot of those other models are super interesting, like HLP or HIP3, et cetera. So kind of that's our focus. And I think that's where you drive the most adoption or kind of, usage or open interest for that matter across perps. So that's kind of our take.
I think for us, it's making traders' money be more capital efficient. We're doing this through a product. Obviously, we're building a perps exchange at Decibel. And most of our product features, while we are really proud of, fully on-chain trading and all of these cool infrastructure advancements, it has to boil down to, why does this matter to traders and why are they going to pick your platform? And I think that one thing that other perps exchanges haven't really committed to is capital efficiency. So this is basically just the idea of making traders' dollars go farther in a not scary risk way. And so, using deposits into a market making vault across an ecosystem more broadly, lending, borrowing on those deposits, being able to open new perps positions with those vault tokens. These are all ways to take $1 of a trader's money and make them, 2x, 3x more effective in generating returns.
It's refreshing hearing that rather than like just your 1001x. Right? It's like,
yeah.
LP tokens as collateral. That is it's a great concept.
We hope.
I think what's the phrase, like leverage, loose morals, and liquor are the three things that ruin it. No, I feel a little bit front run, but I would say collateral efficiency or capital efficiency is definitely top of turban, as I like to say. Being able to have a spot asset and then being able to earn basis yield on it is just a no-brainer, right? And the fact that there aren't more seamless experiences to be able to do this, the fact that I can post BTC, ETH, or any of these other assets as collateral for a portfolio margin position should be a no-brainer. That's one key thing. I think the other key thing is making sure that we're building the right partnership. So the goal of, from my perspective, of Monaco is to build a infrastructure layer such that no matter what the front end looks like, whether you're trading spots, perps, derivatives, prediction markets, you can come to any one spot and be able to access all of these things in a seamless way and be able to use those positions, those expressions of either risk or hedging in any other part of the ecosystem. And so having all of that sit together, risk managed in an efficient and institutional way, I think is kind of the top priority.
I think, so just maybe on that point, we've seen exchanges in the past try and build this sort of liquidity layer where you can build any sort of front end, any sort of application like on top that maybe haven't been able to do it successfully. Maybe that was lack of available liquidity, people to make those markets at the time. Maybe it just wasn't the right model for traders. But now, like something very interesting that's in common across all of the protocols you're building at the moment is that it's a protocol that is also being sort of like partly, that's being incubated like on a general purpose chain. So there's this interesting tension at the moment, right, that we're all aware of between you have perp dexes that have sort of favored this like app specific model, like for example, like Hyperliquid and Lido, right? And then obviously DYDX prior to that. And then you have obviously each of you have chosen specifically to build on more of a general purpose chain where there are sort of different trade-offs, like different design goals with that in mind. So curious to hear, like, you know, you were talking about this sort of composability of this liquidity layer, and that's obviously there's sort of unique opportunities for that when you're building on a general purpose chain versus sort of having to build all of those tools from scratch if you're sort of just, siloed to an app chain yourself. Maybe could you talk us through like the different design trade-offs that, one would consider when you're thinking about general purpose chain versus app chain, and why you've opted to go with like build on a general.
On my side, I think the view is you can either have a heavily high-performant, hyper-optimized, single-use case app-specific chain, or you can build a hybrid model with off-chain matching, on-chain settlement that still gets you the same performance, such that retail doesn't really care whether you're settling a trade in 50 millis or 45 millis or 40 millis, right? That's not really the breaking point. I think the breaking point is you need enough of a clean UX UI to allow people to be able to execute the way they want, but then also be able to do other things when their attention shifts, right? And I think you touched on this earlier, where attention is kind of the key driver of what's driving a lot of adoption across the perp space specifically. So being able to leverage a general purpose chain to be able to trade spot perps, any form of derivatives, prediction markets, all of these things, and create that ecosystem, create that environment, create that sandbox, and dare I say, create that casino where people can switch to whatever game that they want to play is kind of the ideal game, right? And I think you can have app-specific sequencing on a general purpose chain still, which say is exploring even now, to still have that hyper performance in a very specialized use case while still leveraging the broader ecosystem that you're building.
Yeah, I would agree. I'd also say as many use cases as possible coming down into one order book creates the most capital efficient environment. So if you have a lending protocol processing and liquidation, as well as 20 different front ends, all onboarding users across different parts of the world to the same perp market or spot market, that creates a much more capital efficient environment for the liquidity provider. And the liquidity providers are just looking for as much taker flow as possible. So that's kind of our take on the matter.
Right.
I think there's some things that come from the benefit of doing an app chain approach, and one of those things is just the ability to make really opinionated decisions of how trading should work. And it's something that all of us building on a general purpose blockchain have to correct for. Like Hyperliquid, they're prioritizing certain types of orders, right? They have cancel priority, post only priority. That is an advantage for them for sure. And we have spent a long time trying to figure out how to engineer around that. And we have this async order submission model where you can get some of those benefits. But I think also what you have to do is look beyond just the what is the infrastructure you're settling on, and think more about like, what is a business you're building, right? Like building a liquidity layer, you are requiring other really smart entrepreneurs to come in and connect the dots and ultimately add their own spread and fees on top of your layer for that, so that all of you can make money. If you're starting with, we're going to build an app, it's going to be the company that brings institutional market makers on chain, trades from the vault, builds a really great front end with UX. That's really like aligning all of those incentives into one company that is really hard to build. Like you're doing smart contract infrastructure at the same time as you're doing go-to-market and trader onboarding. But it is like, you have one team that's all aligned behind that mission instead of depending on different skill sets to go and accomplish that goal. So I do think it's like kind of a combination. Doing it on general purpose blockchain, you get a lot of that benefit of like ecosystem, onboarding, already existing partnerships. But I think you do have to go that one step farther to like build the hyperliquid of your chain, not just the infrastructure that's going to let other people trade.
Yeah. I mean, we started this point specifically sort of drawing this dichotomy of app chain, general purpose chain. But actually, if we look at the way like Hyperliquid and Lido are both evolving at the moment, Hyperliquid obviously built the app first and have sort of backed into like HyperEVM. Now they are sort of building out this composability, right, and incentivizing builders through builder codes, HIP3, stuff like that. And Lido the same, right? Lido, I think they just recently announced that they're going to launch like an EVM sidecar, that they've talked about composability with like the L1. So I think maybe similar to what I was describing before about how we've sort of seen this like cycle between CLOBs and AMM based, and then now we've sort of arrived at, you have these liquidity pools that are being tapped into for like, market making for the vaults, but you're also like fundamentally relying on the order book for settlement. Perhaps we see that everyone does converge towards, okay, you sort of have to have both. Like you have to sort of put a lot of focus into building out this app, which perhaps a lot of general purpose chains like haven't done in the past. They've sort of like built the settlement layer and then said, okay, like builders will come and build it. Yeah. And then now sort of what we're seeing is like, okay, we actually have to make a concerted decision to build that first. And then once sort of that primitive is available, then it'll be easier for people to build on top of it, right? Once you have a way to sort of provide utility and bootstrap that liquidity.
Yeah. I think it's a lot about the brand. Like for us investing in Decibel, we will have this open ecosystem, builder code, same idea, but we want Decibel to be the like proof of ability to build a business. And if we can show success with that product, then we'll be more likely to be able to say, hey, like really good builder, you should build a mobile front end for this, because you already see the capital that's here, the users, the traders, and they're going to be more willing to just hop over to your app. So
I would reduce it down to like, instead of just saying build the train tracks and then someone's going to build the train, you give them a functioning train and say, hey, can you make this a bullet train, right? What about maglev? What about all these Xers? So if you give them something to actually do that brings in the liquidity, brings in the flood of capital, brings in the intention, after that, then you have a proof of concept to build off of, which I strongly agree with.
Makes sense. So we've been talking about some of the different design decisions around sort of like the PerpDex itself. Obviously, one of those considerations when building a PerpDex is the Oracle. And we're like very fortunate to be working with each of you like on the Oracle front. We made an announcement about a month ago launching a new product built on the DataStream stack called DataLink, which is an institutional grade publishing tool. So it allows anyone with proprietary data, so like a lot of like institutions, exchanges, to bring that data on chain. Yesterday we announced like FTSE Russell. Today we announced TradeWeb. At Cybos we announced S&P and Deutsche Börse. But there are like many other publishers that could be interesting to folks building PerpDexes. And I'm curious to hear, like, because we've been speaking about this obviously with each of you, what sort of you're interested in about this or how this is going to help elevate the product. Perhaps, Alyssa, we can start with you, maybe looking at like listing velocity, right? Like that's obviously like a huge focus for PerpDexes.
Yeah, I think we can build the best trading experience possible, but the easiest way to get traders' attention and have them actually move their money is to give them access to a novel asset that they cannot get on another exchange. You can see the flows of capital when Mega ETH is listed first on some exchange, right? Yep. And you can't launch one of these markets without the Oracle being available. And this is one of those things that, I don't know, we spent a lot of time talking about this. It's complicated to make it happen really close to the launch time for
a lot of coordination
for token. Yeah. And getting that flow down between us, our Oracle provider, our risk side, it's really important. And so yeah, when we were discussing Chainlink supporting Decibel, like we mapped out all of the listing times for the most recent interesting assets, and that's super important to us because it kind of like is the last mile for trader onboarding. Like how quickly can you list that asset? It's going to correspond to how much attention you can get from users. So I think it's one of the most important things that you have control over. So
yeah, and we've seen that with like Trump, like Easy, right? Like I think the sort of tweet that was circulating was like when I think Hyperliquid listed like Easy sort of within, I think it was like 80 minutes, right, of Kanye's tweet. So that seems to be sort of the benchmark that people are...
It's becoming a distribution play. Yeah. Like some of these tokens maybe are going to the exchanges first and helping them start, like, I would imagine it'd be like a little bit of a meeting. Like, hey, right. get your Oracle in the room. Let's figure out how to list this first.
Agreed. And I'd also say it's TradFi products, right?
Yep.
These things are coming on chain. Who can offer the most redundant data feeds, for those things that won't go down with the best accuracy? And I think that, that is a huge differentiator, whether it be US equities or many other things similar to that. We're seeing a huge takeoff across blockchain platforms and ours specifically for perps for those types of, products and assets. And that has been, why we're super excited about the DataLink product.
like I think at the moment there's been like a lot of conversation around single US equities, right? Like that's sort of what everyone's talking about at the moment, and like crypto adjacent, like single equities, right?
Coinbase or Circle or Galaxies of the world.
Exactly. But like, so we just announced obviously FTSE Russell yesterday, and so it probably only takes one thing, like, okay, like indexes are sort of like
The next
probably
thing.
next, right? And
Absolutely.
it's sort of funny because I'm sure you guys like feel so as well, but like the tokenized like RWAs was like such a meme for so long, and it finally feels like, okay, like now it's happening, maybe, right?
Yeah.
Maybe it's the right I don't like.
Yeah. I think it's important because perps are probably the product to deal with that best, given the crypto use case and user or prospective user. And what you need is a liquidity provider and an oracle, right? You don't need potentially a spot asset or a wrapper or an issuer or any of those things. You need an oracle and you need a liquidity provider. I think that's super important for people to understand. It doesn't necessarily have to be this crazy tokenized asset with a custodian and all these sorts of things. You need a market maker that's onboarded and can hedge his positions, and a great price feed like a data link product, and that's all you need about.
Simran, any comments on yours?
Yeah, I would just say, I mean, taking a step back and looking at this kind of ideologically, I'm by no means a blind ideologue, but I would say that for me, the promise of crypto, the 0 to 1, was I don't have a trusted central intermediary where I need to trust them to store my cash, right? That's why we have decentralized networks. But then the next level up is now I should be able to use that value to express whatever view I have. So whether we're talking about having perp exposure to the S&P 500 or levering up 100x on something ridiculous, I should be able to use that same capital in the same way across the board. And I look forward to the point when I can use my Bitcoin or token number 673 on CoinGecko to collateralize my 20x S&P position, right? Like that's for me the dream. But
some have different risk appetites than others, right?
I mean, different strokes for different folks, but
yeah. So we sort of touched on this, or it could be you mentioned this in particular, but like one of the things I think that historically has made people move towards Chainlink has been just the brand and track record around security and reliability. I remember like there were sort of panels maybe similar to this back in 2019, 2020, and a lot of the oracles like on stage and sort of not around anymore. And I think we're in a very privileged position where we've built something over time that has a track record that a lot of new entrants sort of can't speak to. And I'm interested just to hear your thoughts, like how much does reliability matter in terms of like the price feeds you're using for like the certain use cases that they're powering on, whether it be like risk engine, margining, like liquidation, like whatever it is. How important is reliability?
I'd say incredibly critical. The purpose of trading, so people think the purpose of trading is making money. I like to say the purpose of trading is survival, not losing money or making money or byproducts of that, right? And so when you're in a high stress October 10th like situation, or when you have these massive liquidations or ADLs or people are accessing excessive leverage, I think having reliable, robust data pipelines and stringent risk management is what allows you to survive in the long term, right? And so being mindful of data manipulation, being mindful of like, hey, where does my oracle actually perform well? And then where are the edge cases that I need to be mindful of? All of that flows into how an exchange margins, how an exchange manages risk positions, how users should be thinking about their own portfolio margining. And so having something that is verifiable, that is consistent, that is robust, takes into account liquidity, volatility, all of these things I think is of utmost importance.
Yeah, I think you hit it on the head. I think it's like the most critical and important piece to ensuring that, users have safety or security in their positions, right? Scam wicks on other exchanges, those are effectively what Chainlink or a decentralized oracle solution can limit. And I think that, just having reliable and redundant data is probably the most important aspect.
Yeah, like that robust smart price, right? Like if you're a trader and you're constantly not seeing positions filled or whatever, like probably only takes it a couple of times before you're like, okay, I'm probably going to take my money elsewhere, right?
Right.
Like
it takes one bad wick for you to never trade on something ever.
Exactly.
Yeah, I think with DEXs, you're implicitly relying on the code that you're writing. And when you remove the human touch from how a trade is settled, or you get rid of the black box that says this is how matches happen or settlement occurs, you're really just shining a light on all of the inputs to your DEX, right? And if you can't trust the price, then not only is it auditable and people can be like, here are the receipts, here's where you messed up, but you can't have the luxury of being open and transparent trading if that price input is not trusted. So yeah, I agree. I just think it is one of the things that's giving us the luxury of actually doing on-chain trading when we couldn't really do it before. Like I think people have said for a long time that they're a DEX when in reality they're not. But this kind of unlocks that.
I'm just going to move on to the next point. So we discussed before RWAs briefly, right? Again, this is a like major discussion point at the moment, and it's a way we're talking about the importance of being the first to list new markets. Obviously, everyone similar to sort of the vault mechanism is like looking at this at the moment, but because everyone's looking at it, sort of like how do you sort of differentiate within that? Maybe not specifically like how you're planning to differentiate unless you're happy to speak to it, but where do you think the RWA space is going to go in terms of perps? Like, what is the next sort of evolution to this?
Yeah, I mean, I think FX is the most lowest hanging fruit. I would say, like, what is it, 7 trillions and trillions of dollars trade every day on this. So having access to that seems like a no-brainer, and it's a liquid enough market where people still want to be able to access and express a view. Outside of that, I come from a commodities background, so I'd love to be able to trade WTI and Brent again, but on-chain. And then, yeah, I think you have the GameStop crowd, you have the NVIDIA crowd, you have people that are heavily integrated into Wall Street bets. And I think that same kind of ethos and culture naturally translates to wanting to take excessive leverage. So single name stocks is a no-brainer. But I think the goal is not simply which things you're allowed to trade on chain, right? It's not simply, are you listing NVIDIA or not listing NVIDIA? It's more, how do you allow composability with that position to everything else that you're doing at the liquidity layer? I think that's kind of the differentiator. And I think having stringent risk management and composability is how we plan to differentiate ourselves.
I think it's, it's still in the demand proving space. I think I want this to go in that direction. And I think that it's because the mission is very valiant and cool, right? Like we have easy access to buying equity, single name indexes, all of these things very easily in the US, and it's some of the highest growth companies in the world. I think when you say to people in other countries, like, can you get access to these assets? It's a matter of who they are, where they are, and what's their, ability to deal with friction and unfamiliar systems. So like, it is something that I want to do. Like, I want to be able to say that anyone can have access to the same type of investments as I do. I do think that there are a ton of challenges, from pricing to corporate actions, to even like demand and liquidity. But because it's such an area of interest and focus, the innovation is there. It's like kind of one of those things where competition drives innovation. So I'm looking forward to building towards it, and I think it's awesome.
Yeah. I mean, I agree with both of what these guys said. We think it's kind of U.S. equities in the form of perps with access to high leverage, which is much similar to what you see as the leading product across places like Binance or Coinbase. So it's a proven product, and now it's a new asset, and that's kind of our take. And we think that kind of the current bottleneck is liquidity, and we think that a lot of these folks are moving on chain for the first time from the liquidity perspective as they get more comfortable, and that will be really the big unlock to onboarding the next big use cases.
Yeah, one hurdle has definitely been liquidity, and folks being like, how do I, especially crypto market makers, like, how do I hedge myself if I don't have access?
Right.
Lying. A lot of the perp dexes are offering like 24/5 or 24/7 trading of these assets, which makes it even more difficult to like hedge those positions, right? Like Alyssa, you touched on it, stuff like corporate actions data. We've been working very closely with a lot of these tokenized equity issuers to bring their data on chain, whether that be Ondo or X stocks. So on and so forth. Like, I think Tesla has like a stock split coming up next week or the week after that. So things like that, like a lot of perp dexes haven't thought about how do we approach, enabling those markets without sort of being disruptive when you're already supporting trading of those.
I think the tokenized stocks are kind of an unlock for the perps of these assets because of what you said, where market makers can't hedge their positions very easily without these underlying tokenized stocks. But when they are available and readily traded, you can have that same model of crypto market makers hedge perps positions with crypto spot. They're going to be able to do that same thing on chain with tokenized stocks. I think it also helps with this, 24/7 pricing model. Like right now you have to do these crazy inferences, maybe assemble private data. Who knows how you get a price at 3 o'clock in the morning US time. If you're enabling tokenized stocks to be traded as spot, you suddenly have an input price for your mark price in the perps market that you didn't have before. So maybe that's a little bit of a hot take that tokenized stocks are a prereq for perps stocks, but I do think they're going to make it a lot safer and better.
Sure. Guys, I think we're at time. Thank you so much for joining us. And very exciting to be working with each of you.
Likewise.
Just
Everyone getting comfy with the headphones?
This is fun.
Yeah.
All right. It's like we're on a podcast, but we're not. All right. Well, thank you all for joining me today. Really excited to have you in town for SmartCon. I thought we'd kick things off by maybe going down the row here and having you each introduce yourselves. Cody, I'll start with you.
Sure thing. Thanks, Adam. Thanks, Chainlink and SmartCon for having me. I'm Cody Carbone. I'm the CEO of the Digital Chamber. It'll be a very common theme for these introductions, but we are an association focused on advocacy for the blockchain and digital asset space in DC. Been around 11 years and very excited to be here alongside my colleagues.
Great. Thanks, Adam and Chainlink, for having me here today. G. Kim, CEO of the Crypto Council for Innovation. We are also a global industry association. We operate in US, federal, and state, in EU, UK, and the standard setting jurisdictions of Asia Pacific. We advocate for members on policy, legal, and regulatory issues across the world.
And Summer.
Yeah, thanks for having me, Adam and Chainlink. I'm Summer Mersinger. I'm CEO of the Blockchain Association. We're the unifying voice of digital assets in the federal policy space. And it's great to be on the stage with my fellow association heads here.
Thank you all. I want to level set here and say how lucky we are to have the three of them on stage together. They really are the three leading voices in Washington, D.C., representing the blockchain crypto industry. So great to have you all on stage at the same time. Now I'm going to pick your brain at a couple pressing issues. I think you know what's coming. Let's talk about market structure. Market structure legislation was passed by the House. It has been under debate in the U.S. Senate now for months. We've seen draft legislation. There has been lots of ups and downs on market structure. I don't think anyone thought it would be easy, but I thought perhaps I'd start with you, Summer, and get your perspective on kind of where things stand right now and maybe where you think they're going.
Yeah, so I think I bring a bit of an interesting perspective here because I worked on the Hill for so many years, and a lot of those years in the United States Senate. And right now, that's where you're seeing market structure. The most activity is in the United States Senate. What's interesting is there was a strong bipartisan bill that came out of the House. You would think that normally what would happen is they would take up that legislation, pass it, and move it along. But the Senate is a unique animal. They like to do their own thing. They often want to write their own legislation. So they're in the process of kind of creating a structure for for legislation that's slightly different from the Clarity Act that came out of the House. What that means is, whatever comes out of the Senate is going to have to be reconciled with what's in the House, so that'll take some time. Right now, we're waiting for draft legislation to come out of the Senate Agriculture Committee. We have draft legislation from the Senate Banking Committee, but they have to mark that up, vote on it out of their committees, and then merge the two bills together. So there's a lot of steps that are coming up that have to happen before we can see the market structure bill get to the Senate floor.
Thanks, Summer. Cody, let me get your perspective on it. I know you're up on the Hill pretty regularly.
Yeah, and I think right now it's easy to be pessimistic. Summer just laid out all of the steps that are needed to get a bill across the finish line and to the president's desk. We've had a lot of deadlines put in front of us. First, it was pass the bill and sign it before August recess. Then it was the end of September. Then it was the end of October. Now we're looking at Thanksgiving for just a markup in Senate Banking Committee. But the great thing about where we are right now and why I remain optimistic that we will get a bill over the finish line is that there is bipartisan interest. And the committees and both parties are talking to the industry. That's huge. Summer mentioned that Senate Ag draft will come out. They were redlining the Clarity Act, which is a great first step. Senate Banking has been working on this for months. They released a discussion draft. At least Senate Banking Republicans released a discussion draft earlier in the summer. Senate Dems have released principles. They're now having roundtables with the industry. So even though the government is shut down, there is still progress. This hasn't, been put behind us, and this hasn't been put as no longer a priority. So I'm optimistic we'll get a bill done. There's just a lot of steps that need to be taken. It might not be this year. I'm not going to throw a deadline out there, but I think a bill will get done.
Great. You talked a lot about deadlines, and I want to pick up on the last point you made about that. There's a narrative out there that this has to happen this year, before the end of the year, before the end of the year holidays. I want to throw out there, do you think that has to happen? Could this go into next spring? I'll throw that out to the panel.
I'm happy to start. I agree with everything that my panelists have said. I think the way I look at this is we want a market structure bill done as soon as possible. And certainly I am advocating, CCI is advocating for something as soon as possible to get something to the president's desk ASAP. That said, as Cody mentioned, could it slip into next year? It's certainly possible. So from an industry perspective, from TCI's perspective, what we're trying to do is be a resource to policymakers on both sides of the aisle to make sure they have what they need to get this over the finish line. I think one thing we have to keep in mind is we're seeing great progress from the regulatory agencies. Certainly from this SEC, we're seeing an amazing crypto sprint across the board, including the CFTC. But what our industry really wants and should want is clear rules of the road that can last beyond administrations, and that's where market structure comes into play. So for us and for CCI, again, I'm not going to pick a deadline either like Cody, but it's ASAP, this is urgent, this is mission critical, and this is really the big prize that the industry wants and should want to make sure we can build consumer confidence, but also allow innovation to grow here in the United States.
That's great.
Washington loves their deadlines, but they also love to completely miss their deadlines. So it's kind of interesting that they're always setting deadlines, but I don't know if I've seen legislation meet a deadline that's been put out there. It's pretty typical that it goes past whatever they say is going to happen.
Yep.
And the thing that's tough in DC is politics can oftentimes drive policy. And so when you look at what's ahead of us, as soon as the clock turns to January 1st, 2026, during an election year, campaign season, that becomes the focus for a lot of members of Congress. Things just get more difficult as members are not in DC as longer. So we want to get a bill done. You know, there's also the counter argument of why isn't there more momentum or motivating factors to get this bill done now? I completely agree with G and Summer. Like, we want a bill done now. We need it done yesterday. We want to administration-proof this. We want this to stand the test of time. But things are going really well at the two market regulators right now, at the SEC and CFTC, and so maybe there isn't as much momentum as there should be or that there was, but we want a bill done now, and we'll keep advocating for such.
Just two quick things that I'd like to add and agree with what Cody just said. Even with the government shutdown, at least what I'm seeing, I would love to get your take too, is there's been amazing progress still being had, even with the shutdown. So the staffers' offices are working around the clock to try to get a market structure bill done as soon as possible. And also, I know we'll get into a little bit more later on the panel, but the rest of the world is watching the U.S. So as we think about a market structure bill, clear rules of the road, we want the U.S. to lead. And in order for the U.S. to lead, we need that comprehensive legislative framework for our industry. And other jurisdictions have been ahead, including the EU, but this is where the U.S., I call it the race to the top. This is where we want the U.S. To be a part of this process as well.
And I do want to ask Summer and you, Cody, what G mentioned on the shutdown. A lot of us are here. We're reading about the shutdown. We're reading about air traffic controllers, TSA. When is this going to end? But in the context of negotiations on market structure, how do you all see that affecting this? Does it hang over the top of this? Is it slowing negotiations? What are you all sensing on the shutdown dynamic?
What shutdown? Negotiations have not slowed down. They have been moving at lightning speed for Congress. I mentioned those roundtables that have happened with both the Democratic side from the Senate Banking Committee and the Republican side with industry. Those just happened during the shutdown. Now, politics, again, playing a part into policy. Obviously, there is politics as it relates to the shutdown. That is priority number one, as it should be for all of Congress. It should be about opening the government. So market structure might not be the number one priority, as it may be if Senate Banking only had to focus on that, and if Chair Scott or Majority Leader Thune only had to focus on that. So it definitely plays a part. There's also a huge impact the shutdown is having on some of the RFIs and RFPs that are out there as it relates to Genius Act implementation, things that are coming out of the CFTC. So it definitely plays a part, but if you look at all of the activity that's been happening in Washington over the last 2 months or 35 days that we've had this shutdown, a lot has been going on. And it's very easy to say, oh, okay, we're still moving towards getting a bill done.
Shutdowns are interesting in Congress because while the administrative agencies have some, pretty clear lines about who's considered essential and who's non-essential, who's going to be furloughed, Congress really has a lot of flexibility. Each member or senator gets to decide for themselves in their offices, if they're going to furlough people, if they're going to keep them as essential. And so what you see is a little bit different, from across committees, across offices. But one thing that you do notice during a government shutdown in Congress is there's a lot less kind of competing priorities for staff time, that they just don't have the same things that they would normally have in their day going on. And so it does actually free up their time to work on legislation, to focus on things that need to get done. And I think that's what Cody is describing here, is they really almost have a little bit more time than normal to get into the bill and get this legislation going.
And go give your local congressional staffer a hug. They need it right now.
Yeah, they're not getting paid right now.
Yeah,
so.
they're not getting paid. Well, thank you for the perspective on the shutdown. So maybe bad for air traffic control, okay to good for crypto legislation.
It's a bad narrative for us.
It is a bad narrative. I want to touch on something one of you raised about the agencies and the work they're doing. On one hand, we see this push to write market structure rules through legislation. On the other hand, we see the SEC and the CFTC both undertaking very broad crypto-focused projects, producing regulation, guidance, doing lots of meetings with industry. How do you see these two meshing or not meshing? Maybe Summer, since you were a CFTC commissioner, to start with you.
Yeah, I think it's great that the agencies are trying to move quickly and put into place some of the ideas that were in the President's Working Group. They're actually kind of checking those boxes, getting that stuff done. That's all stuff that the agency can do without legislation, without the law changing, and I think that's good. They need to do that. But there's a lot that still requires law, that requires legislation, and you can only do so much on the regulatory side. I mean, and the other issue is you can go pretty far and have some exemptions, and there are some tools in the toolbox for the agencies, but the question is it lasting? Will the next administration follow that same path? Will they keep those exemptions in place, those no action letters in place? And so it kind of there's a little bit of danger in only relying on the administrative side of this. And so that's why you really do need both. You need the administration and the agencies working to fill the holes that they can without legislation, and then you need the legislation to come in and put something that's going to stay, something that's going to stick for good.
And the other one, G?
Yeah, I agree completely with Summer. I think she just said something that's really important, which is you want clear rules of the road that can last stand the time, that can stand the last of time. Did I get that right? And you want something that can last beyond administration. And yes, it's been amazing for the industry to see all this progress from the SEC, even with the crypto spin with the CFTC, all this guidance, no action relief, and hopefully that will continue. But there are still regulatory questions out there. For the CFTC, they don't have authority right now, regulatory-wise, for spot market authority over digital commodities. That can only come, in my opinion, from market structure legislation. So I do expect the regulatory agencies and Congress to work hand in hand. I think that agencies will provide needed TA and analysis to Congress as we look at market structure. But you also need some of these regulatory questions to be addressed, particularly with the CFTC. So again, for CCI, our approach has always been, this has been amazing progress. We're grateful to these agencies for really working with industry for the first time in a very long time. But we also need this market structure bill that can last beyond just this administration.
Great.
The only thing I'll add, and I agree with everything that's been said from Summer and G, the Gary Gensler era at the SEC was only, 10 months ago now? Mm-hmm. Things can change very, very quickly when you're just focused on the regulatory agencies. And so what's to say that we don't know who the next president will be in 2028? Things can change back very, very quickly to this anti-crypto regime at the SEC, at the CFTC, at the prudential regulators. We need legislation that will stand the test of time. There is a lot of the substantive questions as well that need to be addressed through legislation, like giving the CFTC possibly spot market jurisdiction over digital assets. So we need to get that legislation and to work hand in hand with the administrative agencies.
And here's a question I didn't have on the list, but seeing where the conversation's going, I want to ask. I think given where we are post-Gensler, I think there's a sense that industry has a wish list, and they've been getting a lot of it. How much are your members thinking about the potential of things to swing back to maybe where they were or close to it? Is that in the front of their minds? Or are they just thinking, hey, we got a clear lane in front of us. Let's get what we want now. If we can't get exactly what we want, let's go with the regulatory agencies. I'm curious how your membership's thinking about that now.
PTSD they always live with. No, I think it drives a lot. I think there was a lot of lessons that were learned from the previous administration. It drives what we're asking for on a policy angle. It drives how we approach the conversations with the regulators. It drives how we don't take it for granted, and we want to get these bills done as quickly as possible. So I do think it drives everything, but I think people are very optimistic. I'm hopeful that no matter who is in the Oval Office, no matter who is at one of the regulatory agencies, that we've now reached a point where digital assets are here to stay. We are no longer arguing whether this is a trend or if we should ban this or prohibit this. There's a lot of nuance in that, but we're now hopefully just going to continue to move forward. But there will always be that PTSD.
Yep.
Yeah. I think what we've seen is that digital assets, as crypto mentioned, it's nonpartisan. It's not an R issue, it's not a D issue, and it shouldn't be. So we're seeing that amazing progress. We're seeing Congress acknowledging that. That said, to your question, Adam, directly, of course, their members are working constructively with the regulators. You know, they're talking to industry, asking for feedback, asking for what the industry needs to grow and build innovation here in the US, which is critical. But again, going back to my earlier point, and the theme throughout this panel is, from TCI's members, we still do want that market structure bill. It's less about a fear or concern that the pendulum will swing back to the Gensler-like days, but we want something that is durable, that can last. And if you look around the world, you have other jurisdictions establishing their frameworks. The US has always been a leader when it comes to capital markets, innovation, and so much more. We need that framework as well. So for our members, yes, we're working in parallel with the agencies, but also market structure, again, is extremely key and pivotal to all of this.
Yep. Thank you. Let me change gears a little bit, and let's go into the Genius Act. So I think most people recognize Genius Act was really the first comprehensive bill passed by Congress and signed into law affecting digital assets. We are now in the phase where the legislation gets turned into regulations. Various agencies have a say in this. One of the big issues that has arisen since its passage is the ability for centralized exchanges to pay rewards to holders of stablecoins. This issue, many in TradFi, in the banking sector, want to reopen Genius and prevent exchanges from paying rewards on stablecoins. It's become a big issue in Washington, D.C. Curious what you all think about it. I'll start with G.
Sure. I think when it comes to Genius, and how many minutes do I have? I could go on for a while on this issue. It's important to keep in mind that it was forged through compromise, number one. And Congress wanted to make sure that consumers could get the benefits of certain economic incentives when it comes to stablecoins, including rewards. At the core of what Genius is to me, it's pro-consumer benefit, pro-innovation, and pro-American leadership. And when you think about how stablecoins can grow, gain traction, and adoption here in the US, stablecoin rewards are extremely pivotal to all of this for several reasons. One, if you are an exchange or a platform and you want to provide rewards to your customers, that's all about customer acquisition. You want to keep your customers on your platform to buy, use, sell, trade stablecoins. But you also want to incentivize them to use your platform for other products and services, which in turn provides for customer loyalty. Which brings us to the third point, which is very critical as well, which is this actually helps merchants accept stablecoins as a primary tool. If you look at the evolution from cash to debit and credit cards, it was all about consumer demand. Merchants started using credit cards more once consumers use credit cards more and more versus cash. So merchants want to be part of a competitive payment system that is frictionless, lower settlement times and costs, but there's also strong, robust consumer demand for it. And that's where rewards come into play. The second point that I would mention is also that Congress historically has always been about providing consumers the benefits of payments and incentives. That's historical, and I believe Genius is consistent with that legacy. And the third thing, very briefly, is all about U.S. competitiveness. In reality, U.S.-based stablecoin issuers and platforms, they're not competing with U.S. banks. What they're actually competing with is foreign-based issuers and foreign-based platforms. So you want to make sure that Americans stay on and use U.S.-based stablecoins and platforms for U.S. leadership purposes as well. If not, this doesn't go elsewhere. So my view, as you can tell, my strong view is that the intent of Congress was to permit stablecoin rewards. And CCI and our members, we've had great meetings with members of Congress, and I expect that to continue. But I think it's important that we allow for rewards on stablecoins because that's critical and crucial to American leadership when it comes to stablecoins.
I'll offer follow-ups to Summer, Cody on this, and it's a very hot issue in DC. We're seeing lots of activities from the banks fighting it on the other side. So, Summer?
You know, what's frustrating is what the banks are fighting for is protection of traditional banking. They could very easily compete in this space just because an exchange is offering a 3 to 4% reward for holding stablecoins. The banks could certainly offer the same APR on deposits. They don't want to do that. And so the way they are approaching this is let's just stop the exchanges from offering rewards. That is not pro-consumer. That is not pro-innovation. That is just creating a bigger regulatory moat around traditional finance. And it's really kind of disingenuous because they really are, at the end of the day, the consumer loses if they take away these rewards.
I have a lot of thoughts on this that would be more appropriate for the happy hour. But I'm going to take something from something that G said and something that Summer said as well. The banks are fighting against the intent of Congress, and it is disingenuous. This was litigated when we were debating the Genius Act. Coinbase offering rewards off of USDC holdings is not something that is new that came out after the Genius Act passed. This is something that has existed for many years now. It is something that has always been interesting and an ability for a user to interact with digital assets in the market. This isn't new, and now that the fact that they are trying to relitigate this after the bill has passed and been signed into law, as we're going through rulemaking implementation, they are using market structure to lobby for this. I do think it's disingenuous, and I think in our conversations with the regulators that are going to be implementing the rulemakings, I'm hopeful that this will be here to stay and that rewards will continue to be permissible.
Yep. I know we got about 8 minutes left. I got a couple other things I want to touch on. One real quick, I feel like it would be, I think it's important that we touch on DeFi at least a little bit at the top level. It is an important issue in Washington, D.C. Right now, there's a lot of debate about how market structure either deals with it or doesn't deal with it or exempts it. At the 35,000 foot level, I wanted to ask you all about how maybe you're thinking about the dynamics with DeFi. Maybe Summer, to start with you.
Yeah. What I'm finding with DeFi is there's a understanding or a knowledge gap when you're working with the policymakers. I think they really view DeFi as an exchange, something with more control, something with a central entity controlling what's going on these protocols. And we really need to spend more time educating, helping explain that this is code, this is protocol, this isn't a person, this isn't an entity, and really help them understand what we're dealing with, because there's a big chance that they could overregulate in this space. And I think G made the point that people will just go overseas. If we get this wrong and we overregulate and we are forcing DeFi protocols to somehow register with one of the administrative agencies, they're just going to take their protocols, take their code, take their innovation, and just stay off U.S. shores. So that's, to me, the worst case scenario. So I think it's something that they have to, look at very carefully, understand thoroughly before they start making decisions on, what they can or can't regulate.
Yeah, I think on the one hand, we can say that it's a little bit discouraging that we're still having this conversation when it comes to DeFi. But on the other hand, for myself and for CCI, we're excited about this moment. We think this is a big push. We have market structure that's awaiting us, and DeFi is a top topic. And I think members of Congress are honing in on that. Summer's absolutely right. The question is, do you have control or custody of customers' funds or assets or not? And if not, how can you regulate that? But if you look at the Clarity Bill, the bill that passed the House in bipartisan overwhelming fashion, they have all these exemptions or carve-outs for DeFi, which I believe is accurate in terms of how you should approach this topic. Meaning there's a bunch of different decentralized finance activities that you can't just shoehorn into traditional regulatory models or categories. There's a whole legion of folks around the world who are allowing decentralized finance to operate. nodes, validating transactions. They keep the lights on when it comes to decentralized network participation. And we need to understand this topic. And I think Congress, whether you're Democrat or Republican, you're understanding this to engage with industry. So while it is discouraging that we're on this topic still, it is still positive that we can focus on this, and this will be hopefully addressed in market structure in a proper way.
What we always say is that DeFi regulation should be tech agnostic and activities based. If the tech removes the need for an intermediary, don't try to regulate it like an intermediary. But this is really, really difficult. Sandboxes, safe harbors shouldn't be dirty words in DC anymore. We should embrace them with regulatory oversight of how the tech is working. This is new for regulators. And so I am sympathetic that we want this. I think all three of us want DeFi, a regulatory clarity for DeFi yesterday.
Yep.
But we also need to educate the regulators, and that takes time. So I would encourage everyone out there to continue to have conversations, show them the tech. Oftentimes they're just reading about what DeFi is, and there's a lot of misconceptions and poor narratives out there, but as much as we can show them how it works, I think we'll do ourselves a lot of favors.
Yep, great points. The education gap is real. About 3 minutes left. I want to kind of wrap up with a question to each of you. Same question. Predictions for 25 and 26 in the broader policy area here. Your choice. Who wants to start? Summer?
Happy to start.
Yeah.
Predictions, I'm going to take it in a slightly different path. Of course, we're going to keep working on market structure, and my hope is that we get something done. But something I am really excited about, and I think we actually, it's very likely that we will see happen, is some of the tax code changes that need to be done to accommodate this innovation. I think that's kind of part of a three-legged stool here. We needed the stablecoin legislation, we need market structure, but we also need changes to our tax code to make sure it recognizes that digital assets should be taxed. They should not be taxed the way that they are taxing some of the activities now. So I'm excited. I think we're going to, we'll still work on market structure, but I think we are going to see some tax legislation and some things fixed with the IRS.
That's a good one. We hadn't hit on tax yet, so thanks for raising that. G?
Yeah, I agree with Summer. Tax is extremely important, and that's going to be a top focus for industry as well. But I'm going to stay boring, and my prediction is on market structure. I'm a hopeful person, so I think we'll make a mad dash when it comes to market structure. I'm not sure if we'll get the market structure bill to the president's desk this year, but I see it passing this year and getting to the president's desk sometime next year. But I think that's going to be the big focus for industry, for CCI, and that's my policy prediction.
Great. And Cody?
I predict the government will reopen. Maybe I'm just wishful thinking. I couldn't agree more with both what G and Summer said, but I think tax, Summer nailed it on the head. Tax is so critically important. Market structure is needed, we need it, but if we don't get tax clarity and we have a market structure bill, then a lot of these tokens will still be issued out of the Cayman Islands or Bermuda. We need tax clarity to bring it back home. We need it for more activity in the space, more use of payments in the space. I'm hopeful that some of the must-pass bills at the end of the year, like an NDAA, that you will see some digital asset-related bills as it relates to national security, maybe some study bills on tokenization. If there's a tax extender package at the end of the year, maybe that is an opportunity to add some digital asset tax-related legislation. Maybe there's another reconciliation bill that Republicans can pass on their own, where we can add some tax clarity, but tax is my #1 focus as well.
All right. We're winding down the clock here. I really want to thank you all for coming up to New York City, joining us. You guys have a extremely broad and deep amount of experience, so thank you for being here. That's what we got. Thank you all for watching.
Thanks, Adam.
Good morning, everyone. How's everybody doing? I love it. I call it the DJ stage here. Everybody has the headset. We're going to have fun. We're going to talk about two of my favorite topics today, which is stable coins and payment. So my name is Arnaud Simre. I lead the growth at Dune, not the infamous book or movie, but the Onchain data platform. And I'm very fortunate because we have access to data to over 100 plus blockchain protocol data, EVM and non-EVM. And what we all know, I think, is that stable coins are the turning point in 2025. Over $30 billion in on-chain transaction every single day. It's over 60% of the entire on-chain volume every day, and it's growing. So before we get started and dive, I want to give a chance to all my fellow panelists to introduce themselves. Let's keep it short, guys. We'll have time to dive into the topic. And maybe so the audience get a chance to maybe know you personally a little bit more. Tell us one thing after your introduction about your morning routine. What little things that you do in the morning that set up your day that's unusual, maybe a tip for your audience.
Yeah, Sam Fagan, Director of Payments at Polygon. Short and sweet, we want to be the best place to build on-chain payments. My morning routine, I start every day by taking a long walk to my favorite coffee shop. Gives me a chance to reset and just kind of get into a tranquil state before a busy day.
Yeah, hi everyone. Clayton Lowry, one of the founders of the network firm. We're the largest provider of proof of reserves for the Chainlink network. I kind of similar. Take a walk with my dog. You got to get calm to work in this space and do a little meditation. Hi, I'm Ian from Linea. I look after business development there. We're an L2, ZK EVM layer 2, or roll up onto Ethereum. Yeah, I'm getting on a bit. So I was in Japan last year for EdCon, and my wife took me to a Buddhist monastery for a couple of days, and we had to sit cross-legged for most of that time, which was pretty much torture for me. So I set my ambition this year to be able to sit cross-legged for an hour. So I just stretch for about half an hour every morning to try to get, and I avoid looking at price action, and I avoid looking at Twitter.
That's a good tip.
Hi everyone. This is Tao. I am one core contributor for the FX protocol. FX protocol is a trading platform. We are providing up to 7x stress-free leverage on the BTC or Ethereum with a liquidation protection and no funding fee at most of the time. On the other side, we are providing the sustainable on-chain yield. So basically, people can deposit USDC or FXUSD, which is our decentralized stablecoin, on the stable yield to earn the protocol fee. Like 75% of the protocol fee will distribute it to the stable yield. We have distributed over $7 million to the stable yield. So our slogan is leverage trader, no enjoy the liquidation protection and no funding fee. Then the stable farmer earn the yield, which is a sustainable yield. Then everyone sleep well. So for my morning routine, for me, I'm more like a degen person. So I check in DeFi Llama every day. So it's morning routine. I check everything, what's the market, what's going on. Then I start my day.
Great. Thank you, guys. I saw some familiar faces from Miami here. My morning routine is I play padel with my friend at 6 a.m. It's the best way to start the day, I'd like to think. But now maybe to set the stage a little bit on this topic, I think we hear so many news about stablecoin and payments. What do you guys, maybe give us one example of something that's working at scale right now? And perhaps the things that we don't talk is the thing that's kind of stuck, right, in that experimentation phase. And maybe, Ian, I'm going to start with you. He's jet lagged. That's why I'm trying to keep him awake right now.
Thank you. Appreciate it. I'm just glad I'm not sitting cross-legged on the floor. No. And shout out to June, by the way. You know, we run a lot of our sort of information analytics on using you guys, and it's almost like critical to how we run our business, which leads me on to sort of things that are working right. So we launched a MetaMask debit card onto Linear Chain around about October last year. We're into hundreds of thousands of users now, basically, you know, able to either use Apple Pay, Google Pay, or the actual physical card and tapping to spend stables. And that is working amazingly well. I think the critical thing about that architecture was, one, we didn't want to push users to have to deposit their stables into another smart contract. They just leave them where they are and give an approval to spend them. But and the way that we could enable that was basically using sort of a very sort of subtle sort of micro loan mechanism to cover the payment whilst we're taking the blockchain transaction. And so, yeah, we're super happy with that rollout. We're out across most of Europe, well, all of Europe, all of Latin America, Canada, and US, hopefully in the next few weeks. And so that for me is something real. It's the first time I've been able to actually say to my family, look, this is what we actually do. They never really understood it before, but the ability to spend stables out of your EOA is, I think, powerful. In terms of what's like some of the challenges, I think one of the things that I worry about is just the dominance of the US dollar in the payment space. Maybe it's inevitable, but we definitely put in a lot of effort to try to enable local stablecoins as well. A Euro, GBP stablecoin, Brazilian real, Canadian dollar, and so on. But I think we're still very early in the uptake of those currencies as for use on chain. So liquidity is, still to be there. And I think, it's not an area that a lot of people are focusing liquidity on. So I think that's one challenge. And then I think, we're still very early on the institutional front. So I think, but institutions are coming definitely.
Yep.
And, we had some exciting news out of Cybos with the partnership between Swift and Consensus, which we hope to develop out. But so there's lots of stuff coming there, but it's still early, let's say. And, these sort of very traditional systems, it's very contentious for them as to where they choose to transact.
Sure.
And so I think it needs to be done in a very sort of, careful and governance determined way.
And Sab, for you on the Polygon side, what do you see? What's working? What's not working?
Yeah, I think at a basic level, we're giving access and inclusion to folks that might be unbanked, whether it be in Latin America or Africa, allowing them to hold USD-denominated stablecoin in a digital wallet that they can now use to transact locally, a currency that holds its value. So we're seeing a lot of, whether it be businesses or users alike, starting to hold stablecoins, whether it be for peer-to-peer transactions, or we're now seeing businesses in Africa, enterprises, instead of holding Naira, as soon as they accept a payment in Naira, immediately converting to a stablecoin and then holding that stablecoin, which holds value. So I think what we're seeing is increased access and inclusion in a system that currently or historically has been very much fragmented and isolated to the U.S.
Sure. How about you, Clayton? I know you connect with a lot of players in the space. Like, where do you think are the biggest challenge right now? Like, what is one pain point?
Yeah, I think where we've seen some success is a few years ago, we put the first off-chain reserves data on chain with Chainlink for a pretty large stablecoin. And we've been working with Chainlink a long time on this and talking to various issuers about what we call secure mint. And we saw a couple weeks ago an issue with Paxos where they minted like $300 trillion. And this is what we've been saying we can prevent.
One person I heard did not like.
So there's some operational control elements to that as well, for sure. But at the smart contract level, we have this for several stablecoins now and many other tokenized assets. We can put that data in a function of a smart contract and prevent that or any malicious attack in the same way. So we can bring that data on chain, and the issuers can only mint up to what we put in the final reserves amount.
Got it. And since you were talking about proof of reserve, I think I read an interesting sort of dichotomy between that and financial audits, right? But to me, the proof of reserve, depending how it's been done, it's a little bit of a static snapshot, right? It's one point in time. How do we move past just like people who just want to check the box, so to speak, to like a little bit more of that continuous trust, especially as we talk about institution coming on change? I think trust is obviously extremely high. Like, how do we change, I think, the mindset and also perhaps the technology to support that?
Yeah, 10 years ago, no one was even doing the statics. So we're thrilled that that's taken off now a little bit. And Genius is now going to require that at least monthly from a CPA auditor. But about 6 or 7 years ago, we worked with our audit teams at our CPA firm and innovated we were running a dashboard, just a transparency dashboard where you could see where all the U.S. treasuries and dollars were in the custodians and various bank accounts. And we were checking that in real time against all the blockchains that the stablecoin was issued on. And we were like, why don't we, so we have all this data, we have this in real time, we have this system, why don't we layer on a CPA audit report in real time as well? And so now we've done that for many other stablecoins. We have other CPA auditors around the world doing that. So now we're down to every 30 seconds on a reserves audit. And yeah, it's totally different than a financial statement audit. They're complementary. They cover different important things. Sure. There's been people that have been audited in the past that did not have proof of reserves. So
it's changing.
Yeah.
it's kind of interesting. At Dune, we have many taglines, but internally we use this tagline that says the future is not going to be reported quarterly. Why? Because I think, coming from TradFi, we are used to earning, we're still quarterly call. So everybody has kind of like the agenda fully set. And I think, we're changing a little bit the status quo with our industry, and now it's available 24/7. And on the analytics or data front, right, you have to adapt to that. And I think whether it's proof of reserve or through the lens of data, we're trying to change that.
It's important.
Yeah, very important. Tal, I want to talk a little bit more about what you guys are doing, because I think people that might not be super familiar, I should say, with FX model. And, we're in Q4 now. Last month was interesting. A lot of leverage position have evaporated. And I think it kind of showed maybe some fragility around pegged assets.
Yeah.
To some extent. Like, can you talk a little bit about why should the market believe in your protocol, and how you do things differently?
Yeah, that's a really good question. And
Thanks.
so,
Very
yeah. So I do have a good example. In the October 10th, the whole market wipe out almost $20 billion. Panic everywhere, right? So for the FX, no hard liquidation. So the system excluding the rebalance, like we excluding 78 times on the ETH rebalance and 9 times on the WBTC rebalance. So this all excluded by the professional permissionless keeper system. So how it works is like the rebalance system will be rebalance all the long to value over 88% back to the 88%. So you don't get hard liquidated at the bottom. So basically you're doing like a partial rebalance at a time. So when it's back, you don't lose all your money. So also we're trusting the permissionless keeper system, right? So during the emergency things, you cannot do anything, right? The gas go up, everything. So we need to trust the professional permissionless keeper. They were doing this kind of system for us. So yeah, so this gives us a good opportunity to prove like we can do the rebalance system for us. So in other words, all the traders, they don't get a hard liquidation. Then for the system, we don't have any bad debt. Then FXUSD, like a hard rocket pegged to the $1. Then FX protocol pass, the hardest stress test in the system. So everyone wins. So like our slogan, smart trader get a smarter, then also stable, earn much better yield. Then everyone can sleep well. Sleep well is very important in the crypto.
So many taglines.
Yeah, we're trying to make sure everyone understand our system.
It kind of got me thinking about, it's kind of like a resilience by design, and curious maybe to hear like, can ultimately the decentralized stablecoins compete, right? When you have decentralized and static stablecoin versus the collateralized back ones, like how do we think between that dynamic?
Yeah, so for us, we define ourselves as a decentralized stablecoin because our collateral is a decentralized asset, which is a BTC and Ethereum, right? And every reserve is on-chain. So like you said, we can use the Dune dashboard to check in our reserve anytime. Right, you can monitoring what's going on there. So that's kind of like a reserve. It's like a back old time, like a US dollar is backed by the gold. Now it's like backed by the decentralized asset, BTC, Ethereum. You can check anytime you want it.
Sure. Moving on to what's happening with my friends at Polygon. Like every time I open something, there's more TPS than ever. The fees goes lower. It's like how much the highway can get cleaner and bigger. At Polygon, it always was better, but like, if you put away scalability for a second, like, what proof do you have that actual businesses are coming on chain? Obviously in the realm of the topic of it's Polygon. Like,
yeah. So, regarding the TPS topic, just for context, we just had an update.
You're in arrear, right?
Yeah. We're at 5K TPS, which just for context is the average TPS that MasterCard does. So we're optimizing for payments. We made a very big shift. We're of the thesis and we have a hypothesis that chains will be specialized and our specialization is going to be enterprise payments. Regarding some of the proof that that we're seeing. I think the way we think about it at Polygon is we're trying to understand the current pain points of the current system or enterprise merchants may be having. Like as an example, Stripe, they use Polygon as their primary chain. Problem they're solving long term, they want interchange or transaction fees for small and medium sized businesses to be lower. So they are starting to build a lot of on-chain products to serve their core base of merchants. Another example of this is we're working with a top 3 remittance company in the world. If you're familiar with remittances, there's a pre-funding issue. So what that means is they have dormant capital and bank accounts all around the world and currencies that they might not necessarily want to be holding, but they need to be able to balance their books when they're processing these transactions, whether a fee for a business or a user. So what we're going to use stablecoins for is to limit some of their pre-funding requirements for instant settlements. You could talk about a company like Flutterwave, who we just announced is the largest payment service provider in Africa. What they're doing is the use case I had alluded to earlier. They want to provide further inclusion and access to the dollar for citizens in Africa. So I think we take pride in understanding the current systems and really just supercharging or enhancing the current infrastructure for some of these enterprise companies.
Very busy.
We're trying.
I know. And I saw you just hired the head of crypto from Stripe, right?
Yeah,
John, great guy. He's helped.
Yeah. It's been working with him.
Yeah, and I was looking at the Swift booth downstairs. Can you briefly talk a little bit about what the pilot is about? I don't know if everybody's familiar with.
I'm not going to go into a lot of detail about that because I think it's for Swift to really disclose what they're doing. But
it's not going well, or is that going well?
No. Most of the early stage work I think is done. What I'd say is these sort of announcements don't happen overnight, right? It takes a long time to build up trust in like the technology architecture and the sort of foundations of what's being built. We've been working for like over 5 years with, major institutions. Initially, it was around private BESU networks, and we then pivoted over more towards mainnet use cases. And we've done a lot of investment in the open source BESU and Teku clients. And that investment then translated into the rollout of Linear, because whilst we were trying to scale private BESU networks for card payment networks like Visa and MasterCard, we needed to scale from like 12 TPS to tens of thousands of TPS. And we were looking at sort of layer 2 type mechanisms and sort of the ability to roll up transactions. And so all of that investment, and then also adding in privacy as well into those. And that was possible in the private BESU networks. And so all of that sort of R&D and sort of proof of concept work that happened, sort of between 2019 and sort of 2022, let's say, is sort of all rolled up into us then doing more work on mainnet and on our own layer 2. And secondly, bringing those institutions towards public networks. Now, I'm not saying they're on public networks quite yet, but they're coming. And I think the exciting thing for us is that, we see the future with them as being sort of EVM based. It's very, very important for us. We're not sort of religious about our own network, shout out to Polygon and what you guys have been doing. We're very keen that mainnet itself succeeds. And we think, the sort of, Ethereum roadmap of scaling is very important, both at the layer 2 level and also the layer 1 level. So bringing these institutions, no, what I'm saying is building this sort of trust with these institutions and bringing them onto this architecture ensures that architecture.
What's missing? Because I'm hearing a lot of those institutions doing things like sandboxes, proof of concept. Like, how can we convince those banks or payment network to actually use stablecoin, not necessarily behind those closed doors?
So I think that, first of all, these organizations are looking for a continuous set of proof points, right? In fact, Swift were just presenting downstairs and talking about a whole load of different proof points and areas that they're, at the end of the day, they have responsibilities to their stakeholders. And whilst we're used to working in a sort of trustless environment, they can't abide by things like, the BitGet hack for $1.5 billion, or the more recent sort of balancer attack and all these sort of things. Like, these things are very difficult for them to, they could be catastrophic when you're starting to move, let's say, $100 trillion worth of RWAs over or whatever.
Sure.
Or you're sending, hundreds of $1 million in single payments between entities. So I think what we're doing is working on building up layers of security, compliance, identity, privacy, all of these sort of blocks. One of the things that we've been involved with, and I know that Polygon have been involved with, is, for example, Chainlink's ACE program, where they're bringing asset compliance engine on chain, and all of these things then link identity, privacy, compliance, KYC, all of these things together. And so I think, and it takes time to prove to these entities that the fundamental building blocks are there and they're trustworthy and using it. But I think the most important thing is to actually listen to what their requirements are and what they need, rather than just say, you need to be, you need to just go full trustless, permissionless, and so on. It's like, it's very, and then
taking time here slow too. So you have to go out there
and then trust a DAO, for example. These sort of things are very difficult for them to adjust to. So it's about listening to them and saying, okay, what type of governance do you need? What type of compliance do you need? What type of security do you need? What type of identity integrations do you need? All of these things to make it possible for them to start transacting. And these processes take time, unfortunately.
And Clayton, on your side, like, obviously you work in the crypto space, but how do you have to change maybe your organization from a mind perspective? How do you, at Dune, we're kind of split between our DGEM crypto roots, but also working with enterprises, government agencies, and all of that. So how, as a company, as an advisor in the space, you kind of like, it's a little bit of a dichotomy how to balance the two together.
Yeah, you got it. I think it's the right people. Some of them you kind of push into the DGen side, and some of them you put the suits on them and put the traditional side up. But yeah, we have conversations all the time with both sides, like stablecoins that are very more kind of DGen, and there's just so many banks that are right now that are community, small banks, big banks that are really looking at their strategy here, and we're seeing so much opportunity on that front.
Yeah, and since we have two chains here, I want to talk a little bit about interrupt, right? In a sense, like so I put someone in between so you guys don't fight. But on one side we have Ag Layer, on the other side we have ZK EVM, and there's other things happening, outside of the two of you. But just curious to have your take around, like, are we evolving towards more of a network of networks that somehow are well connected, so to speak, or we're just pretending, and those are just ultimately different ecosystems that don't really communicate at the end of the day? We don't want to say it because, we're all aiming for the same North Star, but you can go first.
Yeah, so I think if you ask a few people at Polygon, I think we'd have different responses to this question.
I heard Sandeep is in town, so be careful.
Yeah, Sandeep is in town. So, I mean, I think ultimately, when we think about this long tail, Ag Layer will be a very important layer when we're talking about unified liquidity for settlements. But right now, I think we're at this stage in which chains are starting to specialize. Polygon, as an example, is very much focused on payments. You might have other chains that are focused on high-frequency trading and meme coins. But for us right now, I think we want to be really good at the one thing that I think we're really solving for, which is really on-chain payments at scale. We're starting to build FX on-chain. We're starting to think about on-chain credit, yield. So we're really focused on layering in new payments use cases for our specific chain. So right now, I think we're going to be specialized, but I think long-term interoperability and a unified settlement layer will be very important. There's a company called Ubix. They're a stablecoin clearinghouse. I think they're going to play a very, very important role long-term when we're looking at tokenized deposits as an example. So
Shout out to the Ubix team.
Yeah, I don't think that interoperability will be solved at one part of the stack. I think that, sort of going back to sort of the database world, you have integration at sort of the network level with sort of real-time streaming between databases. You have integration at the sort of data layer. You have integration at the application layer, and then you have integration at UX layer. And all of those are valid integration ways of like creating interop between databases, let's say. And I think that those sort of mechanisms will arise in our space as well, where I think we'll have certain groups of chains that will be able to interop, let's say, at a native rollup layer. Others might be more sort of interop at a based layer. Others will be interop through protocols and things like ag layer. And then others will just like literally be interop via sort of smart contracts and assets, assets that interop across chains. And I think it's all okay. As in, I don't think you have to have like a single magic bullet for all of this, because first of all, like we can't guess what the next sort of hot bit of technology is going to be that everyone's going to get excited about and want to deploy stablecoins onto. And we have to have all of these options available, I think. So I know, especially in Ethereum and other parts of the ecosystem, everyone gets very sort of heated about interop and what's the right way to do it and so on. And I'm like, my view is like, chill, bro. Like it's, we are working on different layers, and the solutions that fit specific use cases will be utilized. And I think just let the market do its thing, right?
Yeah. A lot of good advice. One thing I hate about panel is at the end, everybody is asking about the prediction. No one has any clues. No one forget what people say. So I'm going to maybe reverse that as we're coming up on time here, starting with you, Tao.
Yeah.
If we think stablecoin are going to go mainstream, I don't want to hear your prediction. I want to hear who loses.
Who loses?
Yes. Who loses in that?
I think most of people win. Then I think the lose part maybe they just change the format, right?
Okay.
The bank probably go to more like a stable side. So the whole thing change. Like the retail go to the online retail, right? Like Walmart doing all of the on-chain stuff. So that's kind of things will be later on doing the same thing for the bank or the stuff. So I think most people will be changing to the stable side. That's what I think. And everything should be verified on chain. No, you don't just trust the name. Everything should be trust online. That's why kind of we do for the FXUSD. You don't just trust the name, just verify on chain. Yeah.
Chetan, do you think it's the bank, the card network, maybe DeFi itself that loses to some extent?
Yeah, I actually think it's the other central banks that aren't the Fed. I think it's other fiat currencies around the world. I think dollar dominance in stablecoins continues. And as they achieve full adoption, that's a real threat to the rest of the fiat currencies around the world.
Yeah, so I think margins overall in payments are going to get very thin. Remittance companies, as an example, make a lot of money on FX. Banks make a lot of money on FX. I think we'll start to see kind of these layers in between as there's more exposure to stablecoins, like a trustless layer, like Stripe as an example. So like Visa, MasterCard historically have been this layer of trust and governance. Right now, Stripe is KYC'd 96% of all card transactions in the US. So they have this layer now of trust and governance that I think long-term can really disrupt. And I hate the word you use the word disrupts. But I would look out for Stripe to start becoming a network that is somewhat synonymous with Visa, MasterCard when we look at the next 10, 15 years.
We are disrupting a little bit the timing here, so we're going to have to shut it down. But if you want to learn more about Dune, Polygon, the network firm, our friends from Linea or FX Protocol, we're going to be hanging out in the back. Thank you very much to the entire Chainlink team. Amazing event. And go stablecoin. Thank you.
Thanks, everybody. Thank you.
Hopefully many of you know Zero Hash. We founded the company in 2017. And our vision is to effectively bridge traditional finance with this emerging technology. So our thesis is very simple, that crypto is a technology as opposed to an asset class. And it's adjusting the way that value is transferred globally, both in terms of how we move investable assets to stable coins, to anything in the world. We provide a global footprint, so we've really lent into being a one-stop solution to every company in the world that wants to serve its partners across both stable coins, crypto assets, and tokenized assets. For example, at the end of last week, we received our MiCA approval, which gives us access to a homogenized market in the European Union. We're one of the earliest players in the United States. We never left the United States. We continued building here, despite some of the challenges, and we're regulated in every state. And really this provides the building blocks of trust and the foundational pieces to enable partners to build on this technology stack. So our core thesis is that this technology is adjusting the way that we think about both tradable instruments and payment instruments. We believe that if you make it cheaper, more easy, more fractionalized, you can make everything a payment instrument. So this construct of having an investments account and a payment account starts to blur. And you'll see this in our client base, that effectively many of our clients start with us on the trade side, but they very quickly realize the power of this technology from a payments instrument side as well. So we today service over 6 million end customers, 75 platforms, everyone ranging from interactive brokers, Morgan Stanley, to Stripe, Shift4, Franklin Templeton, BlackRock. And we've really lent into providing a global infrastructure across a range of assets and a range of chains. So this gives you some sense of our client base. So you can see here on our trade vertical, many of the leading names. On the transact side, again, we work with, for example, groups like Kalshi for instant account funding. We work with payroll companies to allow for freelancers to be paid instantly, globally, anytime, anywhere. We work with some of the largest payment companies such as WorldPay to allow for instant settlement across borders. And on the tokenization stack, we work with a range of players across the space as well. So our thesis is very, very simple in the stablecoin space. Our thesis is that Genius will enable and increase the number of stablecoins that exist, but also increase the number of chains that they're listed on. So we really do believe in a multi-chain, multi-asset world. And what this does, what this technological evolution does, is it creates massive fragmentation. And so our mission on stablecoins is to abstract away this technological complexity around stablecoins and to make it effectively an account-to-account movement. For this technology to become usable, it needs to be me funding an account. For example, me funding my Interactive Brokers account, me funding my BlackRock account. The construct of clients thinking in terms of chains or assets, we think presents a massive, massive barrier. And so abstracting away that complexity is increasingly important. So we are the gateway to stablecoins. Many of our partners build and have, and we abstract away the complexity of stablecoins, both from a chain perspective and an asset perspective. And so our thesis is very simple. This chart gets much bigger this way, and it gets much bigger this way over the coming years. We solve interoperability. Again, the construct of enabling these various chains and various assets to communicate with each other is incredibly important. And so we call this product C3. It's interoperability across chain, across asset, and across, for example, a stable coin to a stable instrument. For example, USDC to Bittensor. So this construct of being able to make these things interoperable, it's just money, is very, very important. So today I'm just going to focus on one product set that I think is incredibly exciting, which is our account funding product. And we have a number of announcements here, so I wanted to focus on that today. So here, for example, is tastytrade, a regulated broker-dealer, one of the largest brokerage firms in the United States. You can go there today and you can fund an account with stablecoins. The reason that that's important is you can fund anytime, anywhere. And that is incredibly important in a fast-moving market. Secondly is Kalshi. So for example, if you want to speculate on a game on Sunday, how do you fund your account? So stablecoins enable that instant real-time movement for US persons. And it's a very, very fast-growing product. For example, with the election today in New York, if you haven't funded your account and you want to trade after 5 p.m., how else can you do that? So stablecoins provide a real unlock for platforms that really care about velocity of money. And then finally is the Biddle token. So again, the promise of being able to move interchangeably between a stable instrument such as Biddle into a stable coin is very, very important. So these are 3 live of many interfaces that we power today. And this gives you a cross-section, for example, from a FINRA-registered broker-dealer to a CFTC-regulated clearinghouse to a registered money market fund. And it shows the degree of trust that we've helped scale to allow these large institutions to leverage stablecoins as a core pillar of finance. So that's it. But if you're interested in reaching out, please reach out to contact@zerohash.com. Thank you.
Hello, everyone. My name is Kevin Liu. I'm the co-founder of Metis and Go Network. I started my crypto journey since actually in 2018. During the past 7 years, what we have been building is a whole set of infra, which includes the one and the only one high-performance zero-knowledge watch machine and proof network that can support both Ethereum and Bitcoin real-time proving. That's the only one we can do that. And on top of that, we have launched Metis, the Ethereum Layer 2, Go Network, Bitcoin Layer 2, Let's AI, the AI agent framework. All these constructions serve one single purpose: to bridge the off-chain world with on-chain world, to bring more users, more use cases on-chain. So regarding today's topic, what's going to happen after so many institutions? Around 20% of the Bitcoin has been acquired by these large institutions. What's the next? We sat down with them, face to face, and we ask, what do you need? What we can provide? So almost every institutions mentioned one word: yield. How I can get yield from my Bitcoin reserve? I don't want just my Bitcoin sit idly in my cold wallet or custodian service providers. But it has to be secure and sustained. Otherwise, I cannot pass my internal risk control process. So the challenges here are also very obvious. How this Bitcoin is not designed to be programmable. So how really you can make Bitcoin to work for you and to generate yield. And also how you can not move my assets. I want to control my own assets. I don't want to give up my private key. And also regarding yield, what's the yield? Where the yield coming from? How it's sustained? So many questions. I think for Bitcoin, if you really want Bitcoin to work for you, you will need a whole set of scaling solution that can easy to scale. And also, the very basic part is to inherit the native security from Bitcoin. And of course, if you can generate yield, the yield should be sustainable and better in native Bitcoin. So how this can be possible? And actually, that's what Go Network is doing. We are a Bitcoin ZK rollup to inherit the native security from Bitcoin, and also can generate native yield. The security part actually is composed of a lot of different components. Like we have the zero-knowledge watch machine to verify every off-chain transactions happened off the Bitcoin mainnet. And we use BitVM2, the optimistic challenge process, to verify it, to prove it, and bring it back to Bitcoin mainnet. And of course, the Go network itself needs to be decentralized. Otherwise, there will always be a single party to control your assets. So on Go network is purely decentralized, inherits the ethos from Bitcoin, so you have your own control of your own assets. I think that's the very basic for the yield generation. With this as a foundation, we offer a whole set of BTC5 products, which you can do, like if you are not risk lover, you can just provide, like in our safe box, it's 1.5% APY and partially going to be in Bitcoin. Or if you like risk, you can do staking, lending, yield market, or restaking. It can range from double digits. So where the yields going to come from? That's where our economic model kicks in. On Go Network, the gas fee is paid in Bitcoin. And every sequencer node acts as a revenue generation machine. So for every block they produce, they will collect the gas fee from users. And these business activity or economic activities gonna accumulate by the sequencer nodes. And the sequencer nodes then distribute all the yield back to its users or its stakers. So it's more like the more activities happen in the Go network, the more users, the more transactions, more gas fee going to be collected. And it is in native BTC. So this is the yield generation mechanism. And it's sustainable because what we need to focus on is to bring more users and more transactions. So that's pretty much what we have been building for Go Network. It's a native, CK rollup on top of Bitcoin with the yield generation from all the economic activities happen on Go Network. And why us? It's just as I mentioned, I started my journey since 2018. We have already brought over 20 times return to our early backers. And our technology is one of the top in the industry. We have the economic model to be designed and is sustainable. Of course, what we can bring back to users is the real BTC yield, which a lot of other networks cannot do. So our team mainly located in Silicon Valley and also in Toronto, Canada. We're backed by OKX, Amber, Crypto.com, and a lot of others. These institutions are working with us to generate yield for their BTC reserve, including El Salvador, AAB, Cayman, Chainlink, Waterdrip, Hashkey, and many others. So how we can collaborate? Since we have such a whole solution for the yield generation, if you want to build something on top of Bitcoin, or if you like to leverage Bitcoin layer 2 to build your own BTC5 products, we are open to collaborate. And also, if you are looking for yield, we have a bunch of BTC5 products that works for you. If you have capital, liquidity providers, anything, we are open to collaborate. So if you want to follow us on Twitter and the website, welcome. I think our initial goal is to let Bitcoin really flow, to generate value, to generate the real yield for its users. And I hope we can work together to make it happen. Thank you.
Good afternoon, everyone. Today we are welcomed by two very distinguished guests here at SmartCon. So we have Luca from Coinbase, and then we of course have Mike from General Tao Ventures. Okay, the key thing that we want to address within this fireside chat is really kind of like a co-launch that we're going to do this together with both Base as well as General Tao Ventures. But first and foremost, my question to you, Mike, right? Maybe tell us a little bit about what General Tao Ventures is, and I guess in this case, what Bittensor is.
Sounds good. Maybe I can level set. How many people in the audience know what Bittensor is? And how many people would say they understand what Bittensor is? Okay. So, I mean, for the people that don't, Bittensor is a global coordination and incentivization layer for computers. It's really an abstraction on Bitcoin, very similar in terms of tokenomics, supply schedule, as Bitcoin, 21 million, 4-year halving cycles, proof of work. However, the work on Bittensor is not just doing one incentive. not just mining SHA-256 like Bitcoin. The incentives can be created on Bittensor to do anything. And so it's a global network of computers that you can incentivize to do anything, like training large language models, like price predictions, like 3D model generation. And you can mine this currency, and it's really one of the most interesting kind of parts of the crypto ecosystem, I think, right now. So General Tao Ventures, we're specifically focused on the Bittensor ecosystem. We're developers in the ecosystem. We're vertically integrated, so we build subnets ourselves, which are kind of like the commodity marketplaces on top of Bittensor. We run a mining operation. We run one of the largest validators on Bittensor, Roundtable 21. But we also build applications on top, like the one that we're going to announce today, to try and build utility and also bring liquidity into Bittensor. So we're very much focused in this ecosystem.
Mike, you teased it a bit. Why not let's just like share it? What exactly are we launching?
So in partnership with Chainlink and building with Base, we are launching a liquid staked alpha bridge. So essentially we're taking alpha tokens from the Bittensor ecosystem and bridging them over to Base, creating a new DeFi primitive that people can use to earn yield on their tokens, but also to trade them where the liquidity is on the Base ecosystem. So we're really excited about the launch, fully audited. We're launching it today. So we're calling it Project Rubicon, and we're really bridging the Rubicon into the Base ecosystem and bringing a lot more utility and liquidity to Bittensor.
Luca, over to you. Like, Base have been doing a lot within the AI space, right? Has very much likely been the key chain for AI, and intersecting with DeFi, with virtuals and whatnot. But we'll be keen to hear from your perspective. Like, how do you view Bittensor? How do you view the entire AI space in general within Base?
Yeah, of course. So on the AI side, I mean, something that we've just been like very attentive to is like, what do founders need to succeed? I think we actually see this being the case for the Bittensor ecosystem. Why this is so exciting that we're able to build together is because part of the key points of building Onchain is this access to liquidity and these incentives around tokenization and allowing you to bootstrap an ecosystem. And something that the Base ecosystem really prides itself on is being builder first. And I think this is something that the Bittensor ecosystem at large has done an amazing job on. Something I think they've done probably like head and shoulders above the rest of the AI ecosystem in general, but really have not been able to capture that wider and broader of attention because simultaneously they're trying to solve this kind of like further liquidity issue. So now with some of the infrastructure provided by Chainlink, we're making this possible. I think we're also at a stage with Base where we're truly also coming into our own of our vision of truly being a bridge and not just an island, and being this kind of like global liquidity hub where our builders can now go and benefit from the Bittensor ecosystem as well, build on top of these subnets, bring that utility to Base's core audience, retail users, consumer ecosystem, and really I see like both ecosystems thriving together.
Yeah, absolutely. That excites me, and really at Chainlink, that's the core essence of what we have tried to do. Really supporting builders and enabling connectivity between various different chains. Bittensor has been one of the key chains within AI. But of course, like the DeFi utility and basically the distribution channels within Base have been an exceptional benefit, and to connect both ecosystems together has been amazing, right? So on that note, actually, CCIP has also launched and integrated on Bittensor EVM, right? So this will be the first time that we're announcing this as well. That then connect basically like the top subnets, and maybe Mike to you, right? Like, how can you explain what subnets is? Because this is a foreign concept as well as like alpha tokens.
Sure. So you can think of Bittensor kind of like a school for AI. There's 3 participants in the school. There are teachers, there are students, and there are the classrooms. A subnet is like a classroom.
this is where the digital commodity that's being produced is defined. You create an incentive mechanism for a specific digital commodity that you want to produce. In that classroom, there are teachers. Those are the validators. So the validators give the assignments to the students and grade the work of the students. And the miners are the students. They pass the work back to the teachers for grading. The best miner gets paid the most. The worst miner gets kicked out of class and a new miner comes in. So you get this Darwinistic competition where everybody's always in competition trying to produce the best digital commodity for the cheapest, the fastest, the lowest latency, whatever you're optimizing for within your subnet. Currently, there's 128 subnets on Bittensor. And just like you do with miners, where the worst one gets kicked out and a new one comes in, the same applies for subnets. And so they're constantly fighting for emissions of tau, just like Bitcoin miners are fighting for emissions of Bitcoin by running their computers. Now, these subnets, as I mentioned, can incentivize any type of commodity, whether that's decentralized training, whether that's trustless compute, whether that's, anything that you can think of, even protein folding and decentralized science can be done on Bittensor by utilizing this kind of global network of incentivized compute. Each subnet in the ecosystem has their own token. Those are called, in Bittensor parlance, alpha tokens. And these alpha tokens all have prices. And essentially, they're all fighting for the highest relative price amongst the other subnets that gives them tau emissions. So essentially, you're fighting to try and bring more attention to your product within the kind of whole Bittensor ecosystem because you're fighting for, the gold standard tau emissions. So I hope that kind of helps for some people.
Yeah, the analogy of classrooms, I love it. It definitely makes sense. Luca, on your front, I guess, like Mike was mentioning that there's such a wealth of different type of subnets and the type of use cases and enables. What excites you about this ecosystem and bringing on board? I think, Mike, correct me if I'm wrong. I think we brought on board at least 15 of the top subnet tokens, the highest market cap ones, onto Base. So what excites you about the ones on Base?
Sorry, go ahead. Can I just mention? So 15 of the top 15 subnets have signed on to use our bridge. That means they're providing liquidity on Base. They'll be providing both their alpha tokens and USDC to bootstrap the pools. That doesn't mean they're the only people that can provide liquidity. So anybody that holds the alpha token can do so. But the subnet owners are bought into this as well. They want to see their tokens traded where the liquidity lives. And so it's really exciting to be kind of a collective effort. And the other point just to mention is by bringing all these subnets together, we're creating almost this union and this collective bargaining power of all the subnets in Bittensor. And so they can start going to centralized exchanges. And as opposed to having to strike one-off deals to get your token listed, we can come with a collective power of the entire Bittensor ecosystem, or at least the largest players in the Bittensor ecosystem. So it's really exciting.
You can feel the passion in the man.
Yeah. No, I mean, in terms of like what I'm excited about, I think with the subnets that are coming already, one is distribution. So on distribution, this is distribution to builders for developers to build on top of these subnets. To creators on Base to use the subnet infrastructure in ways that they just might have not been used before and have exciting new use cases. Distribution to traders. I think this is something that's probably been lacking maybe the most. And we have a very exciting integration with Coinbase, with retail DEX, where any token that's trading on a decentralized exchange on Base is automatically tradable on Coinbase, which is also super exciting. So now these subnets all have access to all that infrastructure. But something else I'm also very excited about is, again, this with this unified front too, is builders have this question of like, how do I get started? And I think this has maybe been something where Bittensor has been trying to figure out like, okay, like how do we get people started? And what Base has worked super hard on over the last 2-3 years is providing that infrastructure. So we have things like Base Batches, which provides a program for people to submit their builders, submit their projects and protocols, get funded, opportunities to get in front of like larger investors, go to the network school, We have these partnerships with local accelerators across the world. We have a whole builder team that's working on like a very like regional global initiative to bring people onto the base ecosystem. And I think what we're going to see is one, these groups of people now be exposed to the Bittensor ecosystem as well and start building new subnets. So I'm really excited to see we have this unified front coming. The success that these subnets hopefully will have by getting exposure to the base ecosystem, and then also the Bittensor ecosystem itself leveraging the existing infrastructure to onboard a whole new world of use cases, builders, etc., to come on and kind of develop what the next wave of the ecosystem looks like.
Yeah, that's super exciting. And I think this is a point that's often overlooked, which is education, as well as the distribution channels side of house. So enabling like ease of use for users to easily get access and understand and learn more about what this Bittensor ecosystem, the whole world of subnets, what they will entail. And maybe just to kind of like round things off, Mike, like my biggest question is, why do you guys decide to work alongside Chainlink? Like, and what's next? Do you foresee?
Well, I mean, I think your reputation speaks for yourself. One of the largest kind of Oracle providers, most trusted Oracle providers by some of the biggest companies in the world. CCIP has been no short of instrumental for the entire crypto ecosystem to bridge connectivity between kind of disparate chains. So I think coming in and bringing in the reputation, the trust, and the technical expertise of Chainlink in partnership with the team here at General Tao Ventures and working with Coinbase, I think we have some really good, strong builders, strong narrative, and a great partnership to kind of bring this to market and be that liquidity engine to drive the next wave forward for Bittensor.
Absolutely. And then last words, Luca, like what's next for Base, the AI, because you have been leading AI and DePIN, like what next?
Of course. And so what next? I mean, I think we're seeing an explosion with X402 right now. I think we're super happy to see that. I think we're just really seeing the next wave of AI on Base really take off and be super utility focused. X402, Bittensor, these are all real pieces of infrastructure that are getting used by developers that I think it's a large evolution of what we saw in the previous cycle of crypto AI. And we're very happy to see that evolution happening on Base.
Absolutely. We'll be keeping a lookout on Base and obviously how we can actually work alongside with one another here. But we've come to the end. Time's up. But it's great to have both of you here and we can then co-launch this together. Next step, find out more information that you can see in our socials. More will be published out and over socials in the coming days as well. Thanks, everyone.
Thank you. Cheers. Thank you, everyone.
My name is Andrew Clues. I'm the Enterprise Strategy and Governance Lead for the Graph Foundation. With me today, I have Dan Doney, CTO of DTCC Digital Assets, and Derek Meyer, CEO of Data Nexus, a blockchain consulting company, and a member of the Graph Council. Today, we'll be discussing themes around trust, interoperability, and data standards. And to start, a bit of context. DTCC clears quadrillions of dollars of securities transactions annually. They're responsible for corporate actions processing, dividend payments, and settling our trades. But this post-trade infrastructure is facing new challenges and opportunities with the advent of the tokenization of real-world assets. And by that, I mean taking traditional assets like equities, fixed income, and derivatives products and turning them into a tokenized format that can trade on and across blockchains. So one such challenge is trade settlement times, which traditionally have taken days, now resolve within virtually instant timeline. Also, complexity around corporate actions and dividend payments. This year at Sibos, DTCC, Chainlink, and a number of market participants announced a phase 2 pilot where corporate actions were attested to and disseminated across different blockchains. And it was a major step towards the unification of tokenized asset standards. So Dan, I'm hoping you can walk us through what DTCC's role was in that, and if you can walk us through the attestation framework in more detail.
Yeah, thank you, Andrew. So corporate actions are the interaction between the issuer of a security. So if you think of, say, Apple, the company, must interact with its shareholders, the ultimate beneficial owners. there are layers of intermediaries between Apple and its shareholders. First, you have the transfer agent, the issuer, the transfer agent, the CSD, the custodial banking system, the brokerage, sometimes an RIA, and then the ultimate end user. And passing information between those channels means system integration, one system to another, to another, to another, to ultimately give my son his 2 cents worth of dividend from his Microsoft shares. For that to pass through all of those layers, it's enormously expensive. The costs are on the order of billions of dollars a year, and there are frequent mistakes in all of that system integration. Well, blockchain flattens all of that. It's a very different model for connecting both the issuer to the ultimate beneficial owner, but only to the extent that it properly handles data. And you would say, well, blockchain are data systems, so what gives? It's true that ownership, blockchain systems thrive at tracking ownership as data. So when I use an ERC20 token and I transfer it from one party to another, there's an open standard that makes it very easy with just about any wallet to take and transfer that value. That movement throws an event which can be detected and parties can see it in their wallet or in other financial systems. We use the graph as the tool by which we detect that event and then translate it. That's great, but I'd like to get meaning. So for corporate actions, it's very important to understand, for example, the type of the asset. Yeah. So what asset class? There are different definitions between asset classes, even between banks, let alone between the US and overseas entities. So if you're a derivatives trading specialist, the various kinds of derivatives really matter. But if you're looking from a general perspective, it's a derivative to you. Different people will classify based on specialization. So if you're trying to build logic, smart contract tools that govern whether or not that piece of value can be used as collateral, for example, the type of asset actually matters. And here, blockchain is actually missing the system by which where you develop that meaning. So we have ERC standards, and ERC20 being the most notable of those for how we move value. Yep. What we don't have is how we express schema. So if I have 40 tokens in my wallet and I want to know my exposure to South American political uncertainty, how do I look at those tokens and know which ones are exposed? What we've developed is a schema, and we look to open source this to make data sharing across institutions and across jurisdictions possible. A means by which, in the same way that there is ERC 165, so I can look at the token, its smart contract, and I can know what functions does it support. Now I'll know what data does it support. So I can look at it and it'll tell me, I've got a field for maturity date. I've got a field that's agreed on by various parties for asset class, et cetera. This will revolutionize smart contract processing, the ability to do risk management, the ability to automate collateral management and many other financial functions. And a key piece of that, of course, then is as that data changes, what you have is a decentralized database, a mechanism where there is no central database administrator, but all parties can assign meaning to various smart contracts. And if you value what one party says, like the S&P rating, perhaps, of a token, you can look for that property associated with the object, see if it supports it, and work from there. So working together with the graph, we were able to actually showcase this value and then extract that data from the chains so that we can automate financial processing.
And just to add one thing as well, that decentralized database, there's a very key property that enables. And that's when you are indexing something or you're grabbing all the data from the blockchain, you're going to interpret that data and you come to your result. Now, you hope that you do that accurately, right? And you might run multiple instances to check against yourself. But in a decentralized environment, you have the capability of checking your work against other operators. When these actions are done in a deterministic nature, meaning if you and I were to do it at the same, you and I were to do the same work at different times, we come to the same result. Then you can just produce a hash where you say, okay, my hash is 0xabc123. What is yours? It's 0xabc123. Okay, great. Now we have common consensus. And as you have more people producing the same hash, you have more and more confidence that you are indexing things properly.
Now, as I'd mentioned in my introduction there, that the trade settlement times are going to be much faster, potentially in a tokenized format. So I'm curious to know how DTCC is thinking about auditability, traceability, and data lineage when blockchain becomes sort of the record of truth.
Yeah, so last year, the DTCC moved the U.S. financial markets to T+1. That is, from the time when you place a trade, most folks don't realize this, but to the point where all systems agree on the total ownership structure is 1 day later after the trade. There's enormous cost that's associated with that delay that is hidden into the fees that investors pay for transactions that they execute. Now, that was a big step, actually, because the world was and most of the world is still at T+2. Well, blockchain networks are at T+5, 5 seconds. And so it's a much faster world for the ultimate settlement of transactions. And that's ultimately what we're looking to move the U.S. financial infrastructure to T+5 seconds. Now, there is a trick. There's not going to be one chain. There can't be one chain on which all value is represented. So in fact, for all value to settle, that means there's agreement across all chains about the ownership structure. And that requires you to be able to extract the data from the chains, recognize when there are forks that are occurring and when true consensus has occurred, and then establish the total ownership record for assets. Here's why that's so important. If I'm going to pay a dividend and someone happens to be moving value from one chain to another, there's a moment during that bridging operation where that value looks replicated. And it's actually owned by a party. It's just not available for use by that party. Actually instrumenting that process so that you can understand and never double count, never undercount, and properly give at all points in time, at every nanosecond, the total ownership distribution requires a lot of advances that we're working on now. But a big part of that is, look, folks, a blockchain ledger can't be the final record because there's many blockchain records, and you need to have an overarching record of the records. So that's the piece we're working on together with the graph.
So Derek, you're very familiar with the graph's tooling. Would you say that there's anything that matches very well to handle these types of challenges with T+0?
Yeah, absolutely. I mean, we have our existing technology, which most people who are DeFi native are very familiar with. That'd be your subgraphs. We have Firehose and Substreams, which was showcased a few years back. That's been picking up a lot of traction, especially for those that are looking at indexing the blockchain from a macro level, as opposed to just a protocol specific, which is what subgraphs are more so focused on. And then later at SmartCon tomorrow, EdgeNode will be announcing a new product. Stay tuned for that, which will just give you more and more data tools inside of your tool belt and ultimately service, whether you're a protocol, a company, a financial institution, whatever you are, you can utilize those tools to achieve that.
Perfect. Thank you. So with the time we have left, if there's any key point you'd like people to take away from today's discussion, what would that be?
We're on the verge of the semantic web. So when Tim Berners-Lee actually invented the World Wide Web back in the early 90s, the expectation was that all objects on the internet would describe themselves, and machines could reason over those objects. For a variety of reasons along the way, we were never able to achieve that actual vision. There were many efforts, RDF triples, et cetera, et cetera. It came down to the inability to do read, write, own, that is ownership over the assets and the value and the meaning of that value in a model. Well, we've just overcome that. So the exciting thing, it's not just about finance. This is a revolution in data altogether that we think is about to be unlocked. The true version of the semantic web.
Yeah, and I think we'll see the value of that manifest first inside of the blockchain industry, and then because that's where there's the most financial gain, and then we see that start to ripple out from there.
Perfect. Thank you. Really appreciate that. Well, it's clear that the tokenization of assets will change the way that we move value. So please be sure to check out EdgeNode's talk tomorrow. They'll be unveiling a new product that's purpose-built for enterprise and institutional users. And if you have any questions for the Graph team, we'll be available in and around over the next day and a half. And so please enjoy the rest of the conference.
Andrew, let me take a second just for folks who aren't familiar with the Graph and with Data Nexus. So the Graph as a tool makes it very easy to extract the activity that's happening on blockchain networks into a structured format against which you can actually do wonderful things like have meaningful user experience when you're dealing with DeFi protocols and actually understand meaning at scale. So the graph is the open source tool. It's run by a foundation that we use the heck out of in our work. Data Nexus is the team that we've been using to actually extract that value of the graph, to make sure that all of the our $100 trillion worth of tokens that we look to put on the chains have sufficient meaning so that all financial systems can reason over that value. It's been a great, we used to spend years developing these connectors to actually extract the information off of blockchain networks. With the graph, that development time goes down to weeks and sometimes even days. It's a really exciting capability if you aren't familiar.
Thanks so much, Jan. Thank you, everyone.
Hello, my name is Felix. I am the founder of Planet IX, a company based out of Stockholm. I've been around for a couple of years now, part of the Chainlink, TG, and the DAO, etc. We are a Web3 company, game, and especially located on Polygon. We have approximately 500 million NFTs minted in our game ecosystem, and have a strong presence in China. So 95% of our players are from mainland China, and they were first users to blockchain through our onboarding. So they're native Web3 users through our onboarding. We have some good metrics currently and survived this long period of drawdowns, but amazingly a couple of hundreds of millions of transactions and clogged Polygon for quite a while now. So we're happy to finally break free and relaunch our game on a better choice to Polygon, and that is on Base.
Systems upgraded. Welcome to Planet IX Season 2. Let's begin. Ready for takeoff.
Some sneak peeks into Season 2. We have quite an ecosystem on Polygon already with over 100 smart contracts collecting the ecosystem of IX. And we do our token migration the 1st of December and the game ecosystem the 1st of January. So currently have raised from our community over $2 million in stablecoins that we are going to put on the Base liquidity on airdrops. Feels very excited. Planet X has also been part of the Chainlink Build Foundation. So Chainlink is one of the top owners, owning 1% of the supply. And this is also why I'm invited here to release that we are going to give back to the Chainlink stakers from the Season 1 of the build. So 1st of January, all the Chainlink stakers will be able to get rewards in their AIX tokens. I'm super happy to be here and invited by Chainlink. I'm a long-term supporter, so we are avid users of the VRF, and we have spent thousands and thousands and thousands of Chainlink. So this really works. We are happy to be part of the CCIP transitioning over 1st of December, and then all our 450 million tokens in NFTs 1st of January. That's going to be quite a shock, I think, for the Base network, but we will see. Thank you so much for having me, and I look forward to talking to each of you. If you are interested in collaborating or reaching out to a strong Chinese network, talk to me. Thank you so much.
Thank you, everyone. I'm Christian. I'm the CEO and co-founder of My Network.
My network is a build project. We're a modular networking network layer for privacy. So we bring confidential compute on chain, and we've done that primarily with an encryption method called fully homomorphic encryption, which is the holy grail of cryptography. It's the ability to keep data in an encrypted state and process it in that encrypted state. And so unlike the encryption methods today, which are elliptical curve, that secure Web 2, where yes, they're quantum resistant, but you have to decrypt the data in order to process it. In the future, and the future that Mind is helped building with a number of other confidential compute projects, you will no longer have to decrypt data. And so the future of privacy is in fact on chain. There is FHE development happening in departments of some of the biggest companies in the world. Apple famously just put it into iOS 18. Intel has an FHE department. Google, it's being used in defense applications currently as well. But we're one of the first companies that are bringing this into a decentralized environment where it's actually way more applicable, because the key feature is that multiple parties can come and process data while it remains encrypted. So in a Web 2 environment, the data is encrypted when it's sent, and that it's encrypted when it gets to a server, to a custody holder like a Google or someone like that. So we can entrust their encryption methods, and we can trust them somewhat. Of course, there have been plenty of breaches that would have us maybe question that and not be so comfortable with it. But in decentralized environments where you have a number of parties wanting to compute on a data set, or even verify that data, datafy the compute that other companies have done to save them from having to do that, think like KYC or KYB, very important if you can just keep data in an encrypted state. So I'm here today to talk about why that's important and how we're building this on chain. Let's see if the clicker works. It does. Cool. So we all know that the big problem in Web3 is that if Web 2 became Web 3 tomorrow, and if everything that we did was on chain, then your grocery bill and your SaaS subscriptions would all be tied to your wallet. And there are a lot of tools to find out who has a wallet. In many cases, it's pretty simple to do. It's going to get even easier. And of course, the more we do on chain, the easier it is to find your wallet. So today, you'll see whale wallets and we don't know who they are, but that's because that wallet only does that one thing. It holds all that whale's Bitcoin. It holds all their Ethereum. It doesn't do much else. It's not tied to many other wallets. But as we do more on chain, as we start to interact with websites and verify who we are, as we interact with protocols and servers and things like that, it's going to be easier to connect the dots and figure out who you are, who the owner of that wallet is. And so what we're really interested in doing is finding ways to obscure that information, but also do it in a compliant way, having it be auditable on chain and verifiable on chain. So many of you may have heard of ZK. That's right now kind of the running solution to our confidential problems in Web3. And ZK is fast, and it's very scalable, and it's great in a lot of applications. The problem is whoever's running the zero-knowledge proof sees the raw data. They're decrypting it in order to see it. So there's still a vulnerability there. We also have trusted execution environments which are being used. The problem there with trusted execution environments, again, is that you're decrypting the data. Of course, it's in a siloed environment. It's supposed to be safe, but there are still hardware-styled attacks to see that data and to extract that data. And we recently have had breaches as recent as a week ago. So FHE is still, it's the holy grail for a reason. That's not what we call it. It's been called that for 40 years. It just became applicable in the last 10. So we're solving for this in Web3. What my network has done specifically is we've created a suite of products that all kind of fall under this umbrella of encrypted on-chain messaging. So what we're interested in doing right now, because FHE is very compute heavy, is taking very simple computation that you'd want to do over a data set and encrypting that with FHE. So nothing too complex. But if you want to, for example, send assets, one user to another, one EOA to another EOA, we have a protocol where we have a stealth address. That stealth address is generated with FHE. Every single time there's a transaction, and the key is generated and then verifiable with FHE as well. So this is like a stealth address protocol, just maybe on steroids, if you want to think of it that way. Makes it extra secure and allows for parties to send assets. So we actually built this on top of Chainlink's bridge, which is CCIP. So right now, institutions that are using CCIP, if they want to opt in for privacy, if they want an extra layer of security to live on top of the decentralized Oracle network that will execute this transaction, they'll have it with FHE, with quantum resistant encryption.
We also have private agent communication. So we've built a hub network, kind of similar to the Bittensor architecture, where you can access our network for FHE encryption so that agents, when they're communicating, do not have that communication instantly callable by any other agent anywhere else on the web. So that data, if you have an agent that's trading for you and it's got a mandate of like, I want you to, for example, beat the returns of Bitcoin on a, 90-day rolling average, that mandate can be protected. How the agents achieve this, what instruments they use, what exchanges they use, that can be protected so that your whole trading strategy and what the agents are talking about is not just callable by anybody else on the web, any other agent or person. And so the key to this, again, is being modular. Like I said, we're not L1 or an L2. We have a hub network. We have an SDK, which we've actually open sourced. So these are the three core protocols or core components of encrypted on-chain messaging. So agent messaging, which also includes agent memory and the mandate of the agents, and also authority verification. So if you want to have an authority protocol, okay, who's allowed to do what and access what data, we can also encrypt that using FHE. We have true random number generation. So you might be familiar with RANDAO, which is what Ethereum uses. So they have a number generator for all the validators in their validator set to achieve consensus. They have a random number generation feature. We add FHE to that to make it truly random. And then the stealth address protocol, which I just talked about. So this is just kind of a placeholder slide. That's not the actual architecture. But look, why now? Agents are booming. Right now, the problem that decentralized AI is trying to solve for is really accuracy and UX. We don't see a lot of usage there yet. We want to see more on like Bittensor and zero gravity and the like. But in DeFi, the call for privacy is right now. So all these institutions, these banks and DTCC and Swift, they need it and they're looking for options. And in many cases, they're finding that ZK meets their needs now, meet their needs for today, but they're also looking 5-10 years down the road where FHE is going to be the critical solution. So again, we're a channel partner of Chainlink. We're in the build program and we're also featured in the reward season 1. I think that's the slide that I'm on. And we're actively building privacy on chain. So if you have any questions, you can find us at mynetwork.xyz. And I'm Tao of Data, TAO of Data on Telegram, Discord, Twitter, everything else. So thank you. Thank you, everyone. Thanks for being here today.
Thank you, everyone, for joining us today. This is my first time doing one of these setups with headphones, so I kind of like hearing the intro music when we get up here. My name's Eric Turner. I'm CEO at Masari. We are a market intelligence platform for the crypto industry, working with institutions and protocols. We have some great panelists here today, so just want to kick things off and just have everyone introduce themselves and just talk about, what you're working on right now.
Hello, everyone. I think you can all hear me. I can't say I've done this type of setup before, but hopefully it should be a good one today. I lead a lot of ecosystem development initiatives for the Tron DAO. I'm a community spokesperson for it as well, and very excited to really get into the concept of tokenization and what's really been moving along there.
We love you, Sam.
Thank you.
Thank you. I'm Shyam Nagarajan. I'm the COO of Hedera. Very pleased to be here and specifically to be talking about tokenization. It's interesting. Why is tokenization finally clicking? It's not because the technology has changed in the last 8 years, but it's suddenly the governance and the compliance that wasn't meeting up to the standards is now the global institutions are starting to take note. And that's given a huge opening and opportunity for us to change the way how real-world assets, representation of financial instruments, and as well as next level of financial innovation growth could occur on-chain. And that's what we at Hedera are working on with respect to bringing the most regulated assets on-chain in an enterprise-grade, trustable infrastructure.
Nice. My name is Tarab. This is my first time doing a silent rave type of conference. It's really cool. It feels really intimate. But as I said, my name is Tarab. I'm CEO at Move Industries. So we're building a Move-based blockchain. We were in L2, soon to be in L1. And for those of you who don't know, Move was created by Facebook with the Libra and Diem project. And then what happened is Mark wanted to make Zuck bucks. The Federal Reserve stepped in, said, hell no, shut it down. And it turns out that he was just a few years ahead of the curve. And now everyone is loving stablecoins. And I guess we'll talk about why that's happening.
Yeah, I think that's a great segue for the first topic I want to discuss. So I think kind of to level set and kick us off here, this has been something that has been discussed and tried for many years now at this point. I remember us talking about tokenization in real-world assets back in 2017, when it really started to have a proliferation of tokens out there. And I guess my question, Tarab, we'll start with you, is what's different now? Why is tokenization, why is real-world assets, why is this taking off now? What's changed?
I think it's multifaceted. So first and foremost, it's Trump. So obviously, he who shall not be named, Gary Gensler, is now out of the picture, and so people feel more confident. That's number one. Number two is it's always people want to dip their toes in before they cannonball in, and so I think we dipped our toes in with stablecoins. And then we saw Athena, Maple, Ondo, and a bunch. If I didn't name you, I'm really sorry. I love you. Yield-bearing stablecoins. And then the last frontier is probably, depending on how you define equity, it's going to be like stocks and whatnot. And so I think that once people see that there's an appetite, then they'll slowly go deeper down the risk curve, if you want to call it that. And then also just there's more liquidity. And then, of course, Michael Saylor, we love you. Him leading the way. You get Tom Lee, and then you get these DATs. So all these things kind of happening at the same time makes people less risk. They're more risk averse, right? So when you see big traders and hedge funds investing in crypto, it just de-risks for everyone else because no one wants to be, there's a joke. I don't know if you guys watch Shark Tank. I watched a lot of Shark Tank growing up. And so they always say the first guy through the door gets shot and the second guy walks over the dead body. And so no one wants to be the guy that gets shot. So Michael Saylor, he was that guy that walked through the door, somehow didn't get shot, and now everyone is kind of reaping the benefits. So I'll stop there.
Yeah, I think the regulatory side of it is clearly a big difference, right? I think we see the infrastructure and the ability to actually offer these things, that has certainly progressed over the years, but it's a much more friendly regulatory environment here in the U.S. From a different perspective, though, I think Sam, when I look at what Tron has been doing, Tron kind of has this global footprint of stable coins. And when, over the years, when I talk to people, especially people outside the U.S., Tron is one of the top networks that all of these stablecoin transactions are being processed on. So I'm curious, from your point of view, what does the world look like over the past, call it, year or two, and where do you see things heading for tokenization?
Yeah, absolutely. Well, to echo what Tarab was saying as well, I definitely think the regulatory environment being a little bit more appealing in the States has definitely driven a lot of that growth. But to answer your specific question, I think what's really driven a lot of growth outside of the United States is the lack of financial infrastructure and banking infrastructure that there is in those emerging markets. So naturally, a lot of these individuals who can't bank themselves or don't have access to those resources are going to naturally utilize a Web3 or blockchain system. And Tron happens to be that best product for it, given the fact that we're fast, we're reliable, we have had no downtime since the inception of the chain itself, and we're extremely cost effective as well. So I think that in itself has driven a lot of stablecoin growth. And in the past year, we've been able to really unpack that a little bit, see where the major corridors of stablecoin usage is being shown. And that's really in areas like Nigeria in Africa, or Colombia in Latin America, or even in areas in APAC. And so I genuinely believe we're going to see a lot more of that. And I genuinely think a lot more liquidity and aspects of that will continue to grow in the right direction as well, especially as people start developing more projects, not just stable coins, but also other RWAs, whether it's private credit, money market funds, tokenized treasuries, equities, and being able to democratize that in a compliant fashion and giving it access to the rest of the world. I think that's going to unlock a huge amount of opportunity for people globally.
Yeah, that's actually something I was thinking about as well. Stablecoins clearly, first one to get product market fit here. I don't think you can debate that at all. And this is open, for anyone that wants to answer it, but where do you think we're going to see the next big unlock? Is that you just mentioned a list of things? It could be equities, it could be credit, it could be funds. Where do you think the next unlock comes where we're going to see most of that traction on the tokenization side?
So I'll take a shot. I do think the first wave is going to come from assets that are illiquid, and illiquid assets find the venue to find liquidity in these pools, and therefore it allows faster movement of exchanges. So that's one place. You could categorize this into different buckets, right? Anything that you term as illiquid goes into there. I do see a lot of these capital fundraising for private equity, for special ventures, debt, all of that moving into this direction as well. The next level of evolution, which is not being appropriately represented, or rather being not popular, is royalties, licensing, and really it's for example, a mortgage, and a mortgage as representation of mortgage payments, and the aligned transfer of those assets inside it. So we're going to see a lot more of that push from more complex representation of financial instruments that's coming on chain, and therefore it makes it very lucrative for normal investors to come buy these assets and also to do secondary market trading of these assets. So I think that's where the next evolution is going to come. I mean, look, the fact that 94% of the institutions, that financial institutions are today want to do something with digital assets, implies the interest in the market. Now, of them, only 44% of them are comfortable with the governance and the compliance structure that are in place right now to move forward with this. Which means there's going to be a combination of retail investors that are going to be driving some of that innovation, retail organizations, compared to just the large financial institutions. The wave has already started. It's a question of how quickly is this transformation going to occur in representation of these real-world assets.
I'll say that I'm ridiculously bearish on stocks being tokenized right now. I just don't see, crypto, I swear to God, we love to create products and then find the problem, and then we're just like a hammer looking for nails. And it's like, okay, most people, they want to be able to spend and they want to be able to save. So for me, stablecoins, PMF, it's there. But what most people want to do is they want to save in dollars and they want to earn in dollars. And so that's where I do see that if we're able to bring these credit products on chain, or T-bills, just let's say T-bills, way safer. Your counterparty is the United States, pretty safe counterparty for the most part. If you're able to earn 4 or 5% in dollars when your main problem is hedging against your own currency. I used to work at a stablecoin company, and we had a pool for the Naira. And so every single time it would get depleted to 30% imbalance, because that's how much it costs on the ground to get access to the US dollar. And so for those people, if they're able to get access to stablecoins and they're able to earn even if it's 3-4%, a paltry number, they're going to be happy. And so I think once we start there, and because most people don't give a damn about any of these names. I love you, Invesco, Goldfinch, whatever, but who cares? Just, am I going to get my 3%? Am I going to get my 4%? I don't care what type of airplane I'm flying on. Will it get me from SFO to JFK, right? That's all I really care about. And so I think financially, all people care about is, can you get me from A to B? And so I think for us, obviously, we're all TradFi people, and we know all these big names, but no one really cares. All they care is, am I going to get rugged, and can I make some money?
Yeah, I think also to add on to that, I think the accessibility of having a digital dollar to the globe is going to offer that yield incentive aspect to it. Being able to actually hold a dollar, be able to spend it, use it however you'd like, and earn additional yield is going to unlock a lot to it. But I also think non-USD backed stablecoins are going to be something that I'm hoping to see in the coming years or months, if not sooner. And I really think that's just because of the counterparty risk that there is with FX trading or FX risk that essentially happens. And it also opens up FX hedging that can also occur for either institutions or a retail audience that may want to gain access to it as well. So I think that's also another unlock that could potentially be coming in the next couple of months or year.
Yeah, I mean, I've thought a lot about this as well, and I started my career in TradFi working on basically trading ops. And when I think about tokenizing equities and tokenizing a lot of these things, one thing that comes to mind is this really going to be something where we can actually have a true representation of this tokenized asset on chain. What's happening in the middle here? And I think one of the questions too is, where do we see, maybe we think that there's a reason a certain asset class can't be tokenized or it's not as exciting, but even from just like a technical or a compliance or a governance perspective, where do we see potential issues if we really want to grow this into a meaningful industry?
Well, I mean, I think the first one is obviously when I go to redeem my Tesla stock, can I get the underlying money or the stock itself? Like, that's the first and foremost. So that's problem number one. But I'm going to say, okay, let's just assume that every single thing that's tokenized can be redeemed. But the question is who is it serving? So if someone has Tesla stock, how many of you would want to borrow against your Tesla stock? Maybe a few people. But the thing is that if you're in the United States and you're an accredited investor, you can do that already. You can get a bunch of stock, go to your bank, and borrow against it. So again, my question to the panel and to the world is, who are we building this for? So if we think about US folks, they have access to these stocks. If you think about non-US folks, if you're rich, we'll bucket them into like rich and not rich. If they're rich, sophisticated investors, they can get exposure. Like rich people in Singapore can buy Tesla stock. They'll find a way to get it. But the thing is that if someone isn't sophisticated, maybe they're the people we're addressing. But is that a big enough of a market where we build all this grand infrastructure? Maybe the answer is we're building it for the future, and that's a fair answer. But I just want everyone to kind of hold their horses a little bit on, we're going to bring everything on chain. And I actually think it'll probably be like Pareto's principle. There's going to be 5 stocks that people go after, and it's going to be the big 5 that make up the majority of the gains of the S&P 500 anyways. And then that's what's going to happen. But not to sound all negative, we all believe in the future of France here. So.
Yeah, Shyam, I'm curious from your point. I mean, this has been something like when I think about, Hedera and what Hedera has been doing over the years, it really has come from this institutional enterprise perspective, building with the concept of governance behind the scenes and all of these things. So I'm curious where, from your point of view, where you see some of the potential pitfalls or even, I'll flip that around, some of the potential opportunities with what you guys have built when we're looking at tokenization.
Look, when Hedera was conceived, we structured ourselves, we built the infrastructure that institutions, enterprise-grade institutions can actually use. But not just the usage and the infrastructure alone, it's the governance that's made up of a council. We call it the Hedera Council, and it's made up of 39 different institutions. It includes organizations like Google, IBM, Dell. We have Nomura Securities, we got Standard Bank, we got Deutsche Telecom. So all these large institutions actually become and run the validator nodes. We are a public chain, but also permission. So therefore, there is adult in the room that's actually governing this network. That's one. Second thing is tokenization as a concept has been around for a while, ever since Bitcoin, right? But what's really changed now is, one, the governance has changed. The governance and the compliance situation has changed, so that's a good thing. Second thing is this: the institutions are starting to figure a way how to adopt this technology, but still preserve the privacy that they've always had in the financial institution structure. Also want and expect a certain level of enterprise compliance with respect to trust, with respect to finality, no MEV, and fixed fees, and predictable outcomes and economics when they deal with these tokenomics. If all you're doing is take our current representation of our financial instruments and try and say, oh, now here is a new representation as a token, that's pretty much no change. And frankly, it's useless, right? I've seen organizations that create SPVs and take these equities and put them into the share and just so a different regulatory boundary can have access to it. That's fine for short-term purposes, but the long-term, that's not really the outcome that you want to achieve. This technology and this shift allows you to do transformational changes for the financial industry. And that implies you need to have a deeper reasoning why you're tokenizing and who are you taking it to, and is there going to be a secondary market after the tokenization? Today, I can tell you a lot of on-chain tokens are just sitting there. you mint the token and someone owns the token and it's just sitting there. Then the whole point of tokenization is if there is no trading that occurs, because the point is to exchange value and therefore facilitate the trade. So Hedera is focused on ensuring that the transformation occurs inside out and allows the financial industry to go past the regular financial instruments that they have, and to, how can you represent complex financial situations and deals and transactions. So when you tokenize, it brings outcomes and values beyond what you are currently looked at.
Yeah, I want to pull on that thread a little bit, actually, and this is open for everyone on the panel. My question is, who are we building this for? Is this for, me as an individual retail user to actually access some of these markets? Or are we just building, again, copies of what's happening on the institutional side for institutions?
Yeah, I think if I could jump in on that, it depends on the type of product. Let's say we're looking at it from the institutional lens and then the retail lens. I think clearly with the institutional lens, there could be a need for either on-chain equities, on-chain RWAs of such, whether it's money market funds, collateralized ETFs, and things of that matter. But I think specifically with institutions, it's just the matter of actually being able to move money at a faster pace, at a lower rate. I think that's the biggest deal that institutions can gain from it, from at least the tokenization aspect. Now, in terms of the retail audience, because I see it a lot with a lot of the initiatives that we're leading at Tron, it's really just being able to have access to a dollar that isn't going to depreciate depending on the country that they're living in. And I think that in itself is an extremely noble problem that we've been able to solve by utilizing Web3 rails, by being able to take a US dollar, tokenize it, and have it be functional on the Tron blockchain. And obviously that product market fit has been pretty good. We just recently surpassed or got really close to $80 billion in stablecoin supply just on the Tron network. And to speak more into that, I think payments in itself is one of the largest, if not the largest product market fit across the entire crypto space, maybe next to events. But I think that in itself is huge, because now people can utilize the dollar effectively. Eventually, I think non-USD backed stablecoins will eventually pop up just to mitigate FX risk, and then be able to send money, whether it be via remittances, for cross-border trade. For the Web2 space, if you wanted to send money, I'm going to take a step back. There was a study that was done in intra-Africa where they looked at countries within that region, and of that region, they traded about $110, $120 billion a year in capital. Of that, about 10 to 11% of it was lost to intermediary fees or banking fees, about 11% of that. So that's about $9 to $10 billion, which is a lot of money that could be used in that emerging economy to actually boost at a magnitude rate. If you did that on a blockchain or Web3 rails, it's effectively negligent, that fee. So this is essentially about looking at blockchain technology, looking at the tokenization aspect, whether it be from the stablecoin front or the broader asset front, and understanding how can I use this tech to move money faster, lower my rates, can I borrow at lower rates, and being able to then have that secondary market component, which is also very critical, especially if you're looking into like mortgage-backed securities or things of that matter. So I think it's really about just looking at it from two lenses. We're building it for institutions. Okay, what are those products and problems we're solving? And then we're building it for retail. What are those problems that we're solving?
Yeah, I'm a much bigger fan of, like, if you have PMF, just keep building for those people. So when I was in Turkey, I was there for like the summer, and I remember looking, and there was always like a shop that had like a Bitcoin and a USDT, like a tether symbol. I was like, what the hell is this store? And I see them all around, and I go, and essentially it's a place where you can onboard stables to get like the lira, right, to get money. And it's actually cheaper. First of all, if you guys have traveled internationally, you know that they want crisp $100 bills. Like, if you give them a crisp $100 bill, they charge you like a few bips. But if you actually give them USDT, they actually give it for no bips. They just give you a flat rate, exactly what the market is, which is pretty crazy. And of course, when I said, all right, I'm down to do it, at that time I had it on my Phantom wallet, so it was on Solana. And I was like, okay, I have like 1,000 USDT. They're like, no, only Tron. It's like, Tron is like the Coca-Cola of USDT flavors. Like, they don't want anything else. Everything else is a fake. And I was like, dude, like, you guys can accept, like, nope, has to be Tron. So, GG's for the Tron team. But
I appreciate it.
yeah, but the thing is like if they can again start earning yield, again that's where I think it really makes the most sense. And yeah, who are we building this for? I do think it's also like perverse incentives drive perverse actions. So I think like every chain they have like this TVL number that they always want to flaunt. Or like for example, like go to rwa.xyz, right, which is where you can track RWAs. There's like $1 bajillion tokenized, but like, does anyone in this room actually hold one of those assets? Like, do you know someone that actually uses it? No. There's like 50 wallets. It says like 500,000, but come on. There's like a handful of wallets that actually use it. So the question again is like, who are we building it for? I don't know. But I do know that when you tell people it can inflate their TVL numbers and then they can like post it on Twitter and get people all hurrah or LinkedIn or whoever they're going after, you're going to get these types of things. And so I do think that we need to go back towards the consumers, because I think in crypto, and I know I'll get off my soapbox in a second, in crypto, we've always had a very low standard, which is it just has to be good for crypto. But now when you're playing with the big boys, you have to be better than everyone. Like it just you're going against Robinhood. Like, is your UX and UI as sexy and smooth as Robinhood? I remember the first time I used Robinhood, you do it, there's a scratcher, like, oh shit, okay, and then confetti falls, like, oh damn, okay, and you get $5 of a stock that I don't even know what the hell it was. It was like some random energy company. Did pretty well, haven't checked. But the point is that we need to be able to replicate those type of experiences, or else no one's going to care.
Yeah, I think I think all of that's correct. And I remember I was in Istanbul. I saw that whole street, and it's all just USDT and Bitcoin. It's really interesting. Say that we are building this for retails, for individuals. I remember when you paid $14.99 to trade stock on Fidelity or E-Trade, and now it's $0. So I'm curious if we think about outside of the experience and the UX, getting more people that are individuals to use and invest in tokenized assets. What else are we missing here? I mean, does it come down to fees, finality, like interoperability? Where do we think on the tech side we need to be building more?
So I do think, to the point that who are we building it for, is it's not a broad brush that we are building it for everyone. But why would they adopt it is because it's lesser fees, it's more predictable, it's actually bigger value, better economics, all those things, right? Now, in order to support this, you do need integrity of the data that's used to predict what or provide the pricing, the exchange between lira and dollar, or the finality of the trade that you do actually occurs in the next couple of seconds instead of waiting for, the gentleman before was DTCC, T+1. So it's, here we want to do it less than 5 seconds, so that the transaction actually occurs. Value to a retail customer is, you talk about Tron and stablecoin payments, the fact that you could take a payment app and go into a store and do a QR code transaction, the settlement instantly occurs and is final, is of value. And that's how this tokenization shift is actually bringing individual and then also value to the institutions, because it's instant cash, right? And they see cash flow increase as a consequence of that.
I think the tech is like the worst thing to lead with, because at the end of the day, like, I don't know, how many people have iPhones? Like, a lot, right? Okay, now I'm going to ask you, how much better does an Android phone have to be for you to leave your iPhone? For most people, like, I don't give a damn if it's a lightning speed. Like, I don't want green bubbles, right? So, like, or for example, if you've ever been to Disneyland, Disney World, or theme park, they'll charge you like $10 for a bottle of water. Now, I know rationally I could go to Costco and buy like a freaking pack of 36 for like $5. But in that moment, I'm willing to pay the premium because I really don't give a damn, and I'm thirsty and it's hot and I'm freaking in the theme park. And so I think that right now the theme park is TradFi. That's where most people are. But the question is how do you convince them that unless it's as convenient, they just won't? So it just has to be really easy, and people will pay more. Like, we've all, like, there's an Uber surge. I don't care. I need to get there on time. And so essentially right now, all of TradFi is Uber Surge, and we're trying to build like just basic Uber without any traffic, right? And so ultimately it has to be not just a little bit better, it has to be like an order of magnitude better and easier, because one of the hardest things, as I've learned when I talk to Tron USDT maxis, is it's really hard to change consumer behavior. Like that is like the hardest thing in the world, which is why like Tron has crazy inertia and gravity. I'm not a Tron shill, by the way, but I just feel...
I did not pay him to say that.
Yeah.
Sam paid us all off.
But if you're going to pay me, pay it on Tron USDT.
USDT, absolutely.
I got you.
Absolutely. No, but I think to add on to that, I think the stickiness really comes from just the convenience of being able to move that money at will, however you'd like. And we've been able to do a lot of that work earlier on. It really does pay to have first mover advantage, assuming you're not getting shot in the Shark Tank. Yeah, I just wanted to add on to that as well.
Yeah, no, I mean, I definitely think we're closer than we've ever been, but I still think there's a lot of work to do, especially if we think about the asset class growing outside of just stable coins, where we see most of the adoption today. So we got a minute left here. Want to go just do a quick lightning round. What is the most exciting thing in the tokenization space that you think is going to happen, or most contrarian, over the next 12 months? Sam, we'll start with you.
Payments. I think being able to actually move the tokenized assets.
I think a category that has not been touched is intellectual property licensing, and I think that's going to come in huge trunks on chain. So,
my contrarian take, and I have a keynote tomorrow, so I'm just going to front run it, but I think that stablecoins are going to have a huge existential crisis very soon, because one thing that we don't talk about enough is that the US dollar, it's an expression of the US hegemony of the world, right? It's a global currency reserve. So if, for example, let's say I'm another currency, I'm another country, I can't have all my people, like all digital money being dollars, because that completely undermines my currency. I think England or UK, they already enabled something where you can't have more than X amount of stablecoins. And I think that we're going to see that more across the board, because again, the governments do not want everyone to hold dollars because it undermines their currency and their power. So I actually think that we're going to probably see, as this proliferation of stablecoins continues, every government's going to have a look in the mirror and be like, holy crap, like how do we curb this? How do we limit this? And I don't think the answer is going to be that they're going to tokenize their own currency, because if their own people don't want it, there's no way there's going to be a global appetite for the Naira, right? Unless you're trading FX. So I actually think that's going to happen pretty soon.
All right. Well, thank you, everyone, for joining us, and thank you to our panelists for a great conversation.
Good afternoon, everyone. Thanks for coming to our Fireside chat. I'm extremely excited and frankly honored to have David Mills from the Federal Reserve with us today at SmartCon. And we're going to be talking about the future of blockchain in America, and specifically payments innovation, from perhaps the most influential voice in the world on that very topic. So I'm Ryan Lavelle, Director of Capital Markets at Chainlink. And David, why don't you introduce yourself?
All right, thank you. I'm Dave Mills. I'm at the Federal Reserve Board in Washington, D.C. I've been there for over 20 years, and I'm mostly in the policy area around payments and clearing and settlement. So a lot of the kind of infrastructure that supports the movement of flow of value. So naturally, blockchain technology has always been something interesting, and we'll talk a little bit about that.
Great. So, David, I mean, we're at an interesting crossroad. The underlying technology of blockchain and tokenization is maturing, while policymakers are still defining its role in the financial system. So, from your unique vantage point at the Fed, how significant a movement is this for the evolution of payments and settlement systems at large?
So I think it's quite an interesting point in time, because there's a lot of energy and enthusiasm, obviously, to rethink a little bit how payments are conducted in the United States and globally. Payments has been going through a lot of rapid changes over the last 20 or 30 years. So it's an industry that sounds kind of boring, but it's something that has not been sitting still for a long time. So we've seen the evolution of things like PayPal and Venmo. We've also seen new infrastructures in a more traditional context through more instant payments platforms. The Fed rolled out FedNow just a few years ago, as a new instant payments platform for the U.S. The clearinghouse in New York here also has an instant payment platform. So that was a kind of a big movement. But all the while, we've also been trying to better understand and appreciate how distributed ledger technologies, blockchains, could also sort of transfer value. Ever since the inception of Bitcoin, it's something that at least initially sparked a bit of curiosity in some, and then over time, of course, has become a much bigger conversation in Washington and elsewhere in terms of thinking about how future technology could be leveraged, in a broader payments and clearing settlement landscape.
Yeah, I really appreciate your perspective here, Dave. And I think your background is extremely interesting, especially how you got involved in this space. So, you've spent a lot of your career kind of on the mechanics of how money moves, legacy rails to faster payments. What was like the moment for you that sparked your interest in blockchains and digital assets?
So I'm a monetary economist by training. And when I was writing my thesis many years ago, a lot of the topics that I was interested in is the coexistence of public and private money. And I remember when I was looking for jobs at one point, somebody said, well, that question has been settled, right? There's nothing here, nothing to see here. And so it was kind of interesting. And I put it on the shelf. I did a lot of work related to more traditional payments. But then, of course, when Bitcoin entered the scene, I was immediately sort of curious about the way in which Bitcoin combined a number of technological elements to essentially provide an incentive structure to enable a system to transfer value in a way that was ultimately getting the participants to do what the system wanted, which was to essentially create a reliable infrastructure to support the transfer of value. And that really struck me. So, and that was 2012, 2013.
Wow, you were pretty early.
It was pretty early. And nobody at the Fed was really ever paying attention to this until certain actions happened in Europe, where the ECB, the European Central Bank, had to sort of bail out certain banks in Greece. And suddenly in Spain, there was all these hits on Google searches for Bitcoin because the bailouts were not one for one. And so in Greece, and so Spain was next, and people were kind of worried about not being made whole. So they wanted to leave the banking system and go in and look into alternative ways to store their money. And Bitcoin was hit. And so then people started asking, well, what is this thing? And so from that moment on, I think more and more people at the Fed started to understand a little bit more of the technology, although it took a long way. It's still an evolving journey. But there's a lot more since then. We've come a long way to sort of begin to understand more of the infrastructure pieces of what Bitcoin initially was doing. And of course, now we have in a much broader ecosystem.
Yes. And I think that's a good segue into my next question, because the Fed has long emphasized safety, resilience, and payment and settlement systems. A lot of those systems are new, but however, Fed now has been like a very recent innovation, and that system continues to evolve. How do you really see the rise of blockchain and tokenized assets kind of fitting into the mandate? And how do you think it could potentially enhance or maybe make more efficient the traditional ways that we move money today that those systems simply can't do?
Yeah. So a couple of things. So one, the Fed has in its mandate, all know about monetary policy, but really one of the core mandates of the Fed is to promote a safe and efficient payment system. We do that in some ways by providing services to banks, but we also kind of do that more in a policy domain to try to understand, different rules of the ecosystem, establishing some rules, some safety parameters, but also trying to understand how even the private sector can also provide a lot of the support and the infrastructure. So in the context of tokenization and blockchain, so one of the things we did back in 2016, I think, we went and interviewed a number of startups as well as some traditional players, and we wrote a paper that ultimately summarized some of the findings. And I would say it's interesting because we've been talking about this for a long actually quite a long time, at least in blockchain years, right? To sort of identify where can this technology go? And I think we identified a few things, which I think the industry continues to talk about, and the traditional financial industry sees some potential in. And you mentioned resiliency. Operational resiliency is kind of a big thing. Obviously, just the design of a distributed network is sort of already providing certain types of resiliency features. Efficiency has also been talked about quite a lot. Mostly when you think about tokenizing securities, and the infrastructure that's used to help clear and then settle securities can happen much faster. It can reduce back office complexity. Those who, the institutions engaged in the trade see all the same information. So these were some of the things that I think we had identified as sort of the potential. I think we're still sort of seeing, we're at a moment now where there's a lot more new energy and momentum on these things. But I think, trying to realize these things, at a broader scale is I think where we're at in this particular moment. The technology is starting to demonstrate a lot more capabilities. But now it's sort of how do you organize a financial ecosystem around leveraging those? And that's the harder problem, I think.
Yeah, and I think, we're on the heels of the Genius Act. And I think globally we've seen at least regulators or central banks participate at least in being part of that ecosystem, right? And where do you kind of see the Fed as potentially, or where would you see them like to play a role as far as setting standards and also enabling interoperability? And some things that we talked about earlier today was how do you ensure that these things get bought and purchased and sold at par?
Yes. So there's a lot to try to figure out, I think, especially on the last part of what you mentioned in terms of thinking about a world where there's a lot of stablecoin issuers, a lot of dollar-backed stablecoin issuers. And one of the problems you are immediately confronted with is that you don't sort of have in today's sort of more traditional bank ledgers, debits and credits, is that just the unique characteristics of a stablecoin is that the accounting is different, and the accounting is ultimately tied towards the asset and not so much the ledger of the bank. Right. And so that requires a bit of a different mindset around how do you think a dollar from issuer A and a dollar of issuer B can be traded. And that's a tough nut to crack. So you're kind of trying to think of it about, is there a way to enable a broader set of issuers that can provide a lot of competition for each other, much like the banking sector does in the more traditional space, and do that where the dollar, whether it's issued by issuer A or issuer B, can be treated the same by the broader public, and the economy and economic activity can kind of treat the value of a dollar. Now, how do you do that? Some of that's going to be for you guys to figure out, I think. But also, there are episodes in history where, in monetary history, where we kind of think a little bit about how this could work. And a lot of it kind of comes back to clearinghouses and clearinghouse models. In the old days, banknotes might be issued by a lot of different banks. This is predating the Fed and pre-Civil War U.S. history. And these banknotes would be, tied to the quality of the institution. A clearinghouse would sort of kind of form around a regional membership and ultimately sort of be able to honor par redemption for each of the notes. And that system can kind of work. It worked in much more physical form with the banknotes back in the day, because you had to actually physically take the notes and then find a way to clear and settle. But you could think of an analogy sort of building off of technology that could do that in a more efficient and a better way than, say, they did it in the 19th century. But I think the model is there to sort of think a little bit about how you could enable that.
Right. They rode on horseback with their...
They rode on horseback, yes.
They found a place where other folks came to redeem their banknotes.
But I think the key is trying to think about, what stable coins and other sort of tokenized assets sort of resemble. from both historically as well as with what the new technology enables, and understand that there are ways to sort of try to address these problems. Presumably, we could address them in a more efficient, in a more cost-effective way than then with technology, as opposed to the horses and and the physical transfer. Yes.
Well, thank you very much, David. We really appreciate you coming to SmartCon and having your presence here.
Thanks.
Let's give it up for David.
Thank you.
In the Federal Reserve.
Thank you.
Jacob, it's good to have you here.
Good to
Thank
be here.
you for coming to SmartCon.
Yeah, no, thanks for having me. This is an incredible turnout.
Tell us a bit more about yourself and maybe Lombard also.
Yeah, sure. Real quick, nice to meet everyone. I'm Jacob Phillips, one of the co-founders of Lombard. Before this, I was working on a DeFi Perps protocol, also powered by Chainlink for a little while. And then I was at Polychain for 3 years. I was a partner on the ventures team. I did some liquid fund research. I led governance there. I did a little bit of everything. And yeah, Lombard is the on-chain Bitcoin company. You can think of if there's any problem with Bitcoin on-chain, we're looking to solve it. We built a vertically integrated stack across security primitives to onboard Bitcoin, liquidity primitives, that is LBTC and BTCB, which we'll probably talk about, a distribution layer of vaults and Bitcoin aggregator, and then on top of that, a developer layer that ties it all together.
Okay, very cool. You've been in the space for a long time now, right?
Yeah, a little bit. Not as long as some people, but certainly the years are stacking up.
All right, well, good. It's a hard space to be in, and I would love to hear a bit more from you. How does Lombard make DeFi better today? What's the value prop? How do you empower DeFi to do more?
Yeah, look, DeFi, I mean, one of the coolest parts about what Lombard does is we exclusively serve DeFi. Like we are here to make DeFi better in the form of onboarding net new liquidity. So DeFi, I think, had, at one point, maybe before stablecoins really took off, it hit a little bit of like a local maxima where, people were always looking for net new liquidity but couldn't find it. Meanwhile, here's $2 trillion of assets sitting on the sidelines, crypto native, pristine collateral, decentralized, sort of carries all the properties you'd want in a really good collateral. That is Bitcoin. $2 trillion today, maybe $20 trillion here in a couple of years, something like this. And so, there was always this obvious opportunity to onboard Bitcoin into DeFi, but nobody sort of made it happen. Last cycle, you saw WBTC, get some momentum. There's been a couple other assets that have kind of, I think added to the pie a bit. But if you were a big DeFi protocol, you never really cared about Bitcoin all that much. Bitcoin was always a third or fourth thought. I mean, it was an afterthought for sure. Only after Lombard came in, created a catalyst for Bitcoin within DeFi, did you see things take off. So I really think that Lombard started a sort of developer renaissance within the Bitcoin DeFi community. For the first time ever, you saw some of the biggest DeFi protocols in the ETH ecosystem and Solana ecosystem, major ecosystems, start to care about Bitcoin. So every DeFi protocol is more efficient and more competitive with centralized finance apps and traditional fintechs when they have more liquidity, and Bitcoin as collateral is a piece that powers it all. One of the things I like to call out is that most of what people care about in DeFi these days, I think, should be, or at least at the institutional level, is like Bitcoin and stablecoins. And Bitcoin actually, in a lot of ways, helps power the stablecoin ecosystem, because stablecoin yield comes from what? People putting up some form of collateral and borrowing stables against it to go put those to work. Bitcoin is the core source of collateral. I mean, it's the only one that scales to $1 trillion today.
Yeah, I completely agree. I mean, it does make complete sense, right? Bitcoin holders are convinced about their holdings. They don't want to sell their Bitcoin. They still need liquidity. So having the ability to put Bitcoin as collateral and borrow stable coins, it's a no-brainer. And I think you guys were some of probably the first liquid staked Bitcoin to get into Aave.
Of course.
Back a few months ago, right?
Yeah, I think the only, and certainly the largest asset of its kind, LBTC was a yield-bearing collateral, about $1.5 billion in assets. Every new place we integrate that to, a new lending protocol, a new chain, liquidity flows over like wildfire. Even, we just launched on Solana, which will soon be powered by Chainlink, and with almost no incentives, we saw about $100 million in liquidity, almost all of that flowing into Jupiter Land powered by Fluid, which then ended up being borrowed in the form of stables. So yeah, certainly the hottest use case on the market right now.
Very cool. Now with BTCB, right?
Yeah.
How do you make the distinction between the two, and how is BTCB really going to be kind of different than LBTC today?
It's a good question. So LBTC is a yield-bearing form of Bitcoin, meaning your Bitcoin is actually staked into a staking protocol to earn additional yield. There could be other uses in the background of how that yield is produced in the future. But the idea is you put your Bitcoin in, you're always sort of earning more Bitcoin. BTCB is something fundamentally different, and I think it's necessary. It's a sort of a standard Bitcoin wrapper. Your Bitcoin is just secured within the consortium. So LBTC secured within the consortium and staked. BTCB just secured within the consortium. The difference is, I think these two have different use cases. A yield-bearing collateral is an excellent form of capital-efficient collateral that you might stake. If you want to borrow against it, this is a pretty good use case because not only is your collateral just staked in this contract, it's also earning yield at the same time. Or if you want to trade perps, I mean, this has been another good example. The largest ever on-chain options protocol, on-chain options trade. There's been 3 of them that have kind of like progressed above each other. All of them were collateralized in LBTC. However, if you want to trade Bitcoin on-chain, which I think is both the biggest opportunity that nobody's cracked in Bitcoin DeFi and the fundamental source of what will become on-chain yield, in a sense of like, right now a lot of on-chain yield is yield that came off-chain in some form. The actual production of the yield happens on a centralized exchange or somewhere where people are using Bitcoin a lot, or it's in the form of artificial kind of external incentives. If we want to actually create a DeFi ecosystem that produces its own yield, people have to start doing stuff with their Bitcoin. You don't see this a whole hell of a lot on-chain right now. Bitcoin trading is like the thing that does that. And so I think BTCB is certainly needed for this case. So this is one place we're focused on. So the main place that we're focused on BTCB is like, if Bitcoin is going to compete with, if DeFi is going to compete with centralized apps and fintechs, you have to be able to create this, a similar deposit flow and UX. Right now, Bitcoin served really well right now. You go to Binance, you go to Bybit, Coinbase, one of these centralized exchanges. There's a lot of really great places to use your Bitcoin. Obviously, we think on-chain is better, but for the longest time, we've sort of accepted that DeFi was playing at this handicap, and I think right now, many players in DeFi, Lombard specifically in the Bitcoin space, are starting to realize that that needs to not be the case, and so we're building all the tools to fix that. So when you think of BTCB, of course, we're building it as a Bitcoin wrapper, but I think what fundamentally distinguishes it from the crowd is that we're building this to be a developer primitive. And if you look out at the ecosystem of centralized wrappers right now, none of them serve the use case as a developer primitive. They either have restricted minting, so you can't do sort of a standard deposit flow. If I have Bitcoin, I can't actually like put that Bitcoin directly into an application or into that wrapper. I have to, I don't know, sell that back to dollars and then go put those dollars on chain and then buy that Bitcoin and then go to that app. Centralized wrappers have high fees, and I think one of the most important things we're doing is just going out to applications and being advocates for Bitcoin. We are building an SDK to make it really easy to integrate Bitcoin into applications with the exact flow you'd like. We're building the automations. These kind of things, I'm a little bit of a DeFi purist, I think, in general, so I think I had to come to learn these things by talking to users, where I would have thought that DeFi would find a way to adopt Bitcoin even in spite of some of the things holding it back. But no, we need this tooling, I think, to push this forward.
Yeah, I think we're in the same boat in many ways, right? Like our approach at Chainlink has been very similar. You provide primitives for people to build on top of.
Yep.
And you basically provide the tools for the gold rush, right?
Yep.
Which is basically DeFi
right.
today. And you never know what people are going to build, because the beauty with this ecosystem is that anyone can build anything. You now have 7 billion potential builders who can build on chain. It's a way completely, it's a different pool of talents than what we've been used to.
100%.
Finance, fintechs up to now had been very conditioned. It was a small pool, you had regulations. DeFi is where you can really experiment. And when you provide tooling for the space, people build stuff you would never have thought of before.
I love the way you framed that. It's like you build the ecosystem produces more value than you ever could have created independently.
Exactly. That's the whole point of the space, right? From Ethereum to Bitcoin, like it starts with a few people who then create a network effect that then creates what you have with Bitcoin today, where it started with 10, 15 people who believed in a vision, and now you have 7 billion people who know about Bitcoin, right? So that's the beauty here. So tell me a bit more around how do you think of Chainlink in terms of our collaboration together? You guys have been amazing partners. We're working together on price feeds, on proof of reserves, on CCIP. Keen to hear what you think of the products and how they enable your vision.
Yeah, of course. When we were first starting Lombard, I think it was kind of a no-brainer to work with Chainlink. Chainlink and Lombard, I think, are both building in similar ways and building for similar people, in that both of us are building institutional grade infrastructure for institutions and I suppose the future of DeFi, not just not just the short term. And so yeah, it's been a privilege to work with you guys. Obviously, state of the art oracles, absolutely the standard in the space. And then it's been a privilege to partner on CCIP, which has been kind of interesting. This was Lombard was built to serve a very specific purpose, which was onboarding Bitcoin into new ecosystems, and the only way to do that is basically to what ultimately becomes a Bitcoin bridge. So we're building this, and there's a lot of different chains out there to be able to use your guys' infrastructure in addition to infrastructure we've built to sort of power all of this. I think has only helped us to move much faster than we would otherwise. Also, building bridges is scary, I think. So it's been good to have sort of an institutional partner on this. And last, I keep saying institutions, which of course is like this arbitrarily broad term that people use in the crypto space. But what's been most exciting about working directly with you, we catch up a lot of times, is the idea of Lombard and Chainlink going hand in hand. It's sort of like there are a very small number of players within the crypto space ready to take, kind of push the space forward at an institutional level. And to be able to partner closely with you guys, go into rooms together, preach the good word of Bitcoin DeFi, hopefully onboard some of that institutional capital, I think is an amazing privilege for us.
Yeah, likewise for us. I think from our side, we've taken the same standpoint. We have three main ecosystems which we want to onboard in our space. You have the DeFi degens, which we're both part of. You have the Bitcoin folks, and you have the institutionals. Both Bitcoin and institutionals care a ton about security. And the DeFi degens, actually, we used to care more about security. I think right now what I would reproach to our space the most is that a lot of our space has been taking shortcuts to grow more. And I think the folks like us who have kept the vision of having the most secure products you can are in the right path, because institutions and Bitcoin holders care the most about security. And frankly, I think this is why right now they're using you guys the most. It's because you're offering the security they need in order to onboard into DeFi.
Yeah, 100%. That resonates with me a ton. We were just in Korea for Korea Blockchain Week, and then there was Token 2049 after that. If I compare what that feeling was like for the Bitcoin DeFi ecosystem to just a year before when we were just kicking this off, this is 2024, Bitcoin DeFi was everywhere. There were tons of teams building. Everybody was kind of spreading the narrative. A year later, I don't know, 80% of those teams were gone. And I think I used to be an investor, and I look out on the space, and I love Bitcoin DeFi with all my heart, but I can't not look out at it and see that, the types of people building in the space are cutting corners left and right. They are, predominantly builders that are an order of magnitude of lower quality and probably integrity than what you see and building in like the ETH ecosystem or Solana ecosystem. And so I think it takes a project like Lombard and some of the partners that we have that we work with closely in the Bitcoin DeFi space, and of course Chainlink to kind of stamp your brand and reputation on some of the winners. So yeah.
Perfect. So tell me a bit more about the future, right? You have BTCB, you have LBTC. What comes next?
Yeah, I think it's pushing all these together. I have spent a lot of my time lately thinking about Lombard in the form of the Lombard SDK. So Lombard is not building a Bitcoin L2, but we are building a developer layer. And I think that most of the growth in DeFi right now is driven by the applications, not the chains. So if Lombard, as somebody who wants to onboard more users into the Bitcoin space, what we really need to do is find the people who are building the best applications and serve them the infrastructure that makes it really, really easy to onboard Bitcoin. So we're working with a number of Perps protocols, a number of different chains to produce very, very tight Bitcoin applications. That is, when you go to their apps, this should look and feel like a centralized exchange effectively. You shouldn't even really know that you're using on-chain infra under the hood, and even better if you can emulate the exact same experience. So imagine going to a Perps protocol, you click deposit, it shows you a Bitcoin address, you withdraw from your Binance account to that address, it shows up on the exchange as actual Bitcoin, orange coin, not blue coin, no prefixes or suffixes. You use that Bitcoin and then you withdraw it back to your ledger or wherever you want to after the fact. Like, that's the magic experience that takes us to the next level. This is like, I think we started to see the early days of this with some of the stuff that Coinbase did with Morpho, and then you see like a number of fintechs creating different experiences that totally abstract away crypto. I think that's the future. I mean, that's the kind of thing where like like you said, in the short term, I don't know, maybe that doesn't move the needle, but there are going to be billions and billions, if not trillions, onboarded through those types of flows. And so, I think we're spending a lot of time on that right now. Kind of building the roots, recognizing that that's where things are headed.
Yeah, I completely agree with you. I think one of the issues in our space is we get tunnel vision.
Yep.
We get focused on the existing users when 99.9% of the potential is the people who are not yet using our space.
100%,
right?
yeah.
That's the right way to build. Yeah. So tell me, Jacob, any last thought you would like to leave the audience with?
Yeah, nothing too much, I guess, other than continue to follow Lombard. I think we got a lot of things that are exciting. We just announced this acquisition of BTCB. We'll be rolling this out over the course of the next month, and I think that will be a very net new transformation in Lombard. We've now gone from one asset, LBTC, now to a second asset with the Bitcoin wrapper. You could imagine that infrastructure has a lot more generalization that could be within it, and that developer layer I think is going to be really, really powerful, making it really easy to onboard Bitcoin and hopefully other assets in the future.
Perfect. Well, Jacob, it's a pleasure to have you here. Thank you for coming, and thank you for the partnership.
Thanks a ton.